Hello and welcome to another episode of the Proof of Claim podcast. I'm your host, Todd Price. I'm joined with my co-host, Anil Barrett. And today we've got the pleasure of being joined by the Uneducated Economist. He also goes by the name Simon. So Simon, or the Uneducated Economist, is a YouTube economic sensation. I discovered him in the late 2019 or something like that. He was recommended as sound economic advice for the everyday person, and over the years I've tuned back into his content at various times, especially when the economics get a bit hard to understand, and I always appreciate Simon's perspective and his capacity to just break it down without the economic jargon or the stuff that kind of daunts you intellectually, to being able to extract meaningful, actionable intelligence out of the economic environment. So Simon, it's a pleasure to have you here with us today.
Thank you, man. I really appreciate you inviting me on. I'm looking forward to having a conversation with you guys.
Yeah, great. So you're actually our first external guest, because we come from the Bitcoin SV background, more or less. I've been into Bitcoin since 2011, I think, and over the years have taken a foray into all the other, different assets, and then have found myself exclusively just interested in that one. And a lot of our early guests that we've invited on have been people I know from my extended network who, have offered great content for us. But you're the first person we've invited on from external to my network. So it feels a little strange, because I've listened to your content for 6 or 7 years now and know a lot about you, but you have no idea who I am or we are. So a bit one-sided, but yeah, it's great to have you here. So yeah, maybe do you want to tell us a little bit about your background, how you got into being an economist, an uneducated economist, to now the people have said that you're lying when you say you're an uneducated economist, because you actually know your stuff, and how you've actually even found yourself speaking on big stages with some pretty significant, peers now.
Mm-hmm. Yeah, it's quite an incredible journey, I have to tell you, Todd. I never thought in a million years that I would be having a YouTube channel in which that I would be talking economics on a high level on stage, sharing my thoughts with the, likes of Ron Paul or Robert Kiyosaki or any of these guys who I just looked up to as far as major investors or people who I thought were just incredibly knowledgeable about the economy. Here it is. I have this platform in which that I'm sharing these videos with. And again, it's just like something I never thought would ever have taken place. Ultimately, I work at a lumberyard. I do retail sales for a living. I've been doing that my entire life. And I am like obsessed with macroeconomics, like on a level like none other. And I research like 3, 4, 5, 6 hours a day. And one day I'm talking to a colleague at work, another salesperson there, and it's this tall girl named Brittany. And Brittany, like, she's a farm girl, rides horses, stuff like that. And I'm babbling off about the economy, and like I normally would be. And she comes up and she says, "Dude," she puts her fist on my desk and says, "You need to start a blog or a YouTube channel or something, because nobody understands what you're talking about, and you are driving us crazy." And I'm like, "Whoa, gotcha, Brittany. I hear you." I went down to my car, fired up my camera. It was a used iPhone 6 that I bought for $100. Turned that camera on, did an introductory video to the Uneducated Economist, went back into work, used the works Wi-Fi to upload that video to YouTube, and the Uneducated Economist was born. And I started making videos after that. And that's literally how I got the channel started. Never thought in a million years anybody would watch it, right? I didn't. I thought, like, when I got views, it was my mom and my sister and my wife, my friends maybe, even they didn't want to listen to it. One day I'm starting to include ideas of the building industry because I'm working at a lumberyard. I know a lot about lumber, and I'm including lumber into my idea of what's taking on with the housing market and what's going on with macroeconomics. And again, it was getting kind of noticed, a little bit. Got a few thousand people who kind of paid attention a little bit to the channel. And it was when COVID kicked in and the shortages kicked in and the supply chain of lumber was severed, and there was like this extreme move in lumber, and everybody wanted to know what happened, and my channel just blew up. Of course, along the way, I met some really cool people. Gave a shout out to George Gammon. Just out of the blue was a comment section that said, hey, you should check out George Gammon. Way before he ever got popular with his channel and his, idea of the rebel capitalists and stuff. I gave him a shout out saying, hey, this guy's really cool. He does these whiteboard videos. That little shout out connection made a nice little friendship between the two of us. And he invited me to go speak after the lumber prices took off. He was like, dude, I got this whole economic seminar. Come down, speak. Next thing I know, I'm on stage in front of 850 people, like talking macroeconomics. And I'm just like, well, how in the world did I get here? So ultimately, it was just my obsession about macroeconomics. And anytime I ever had somebody ask me a question, or if I ever had a question myself, I would just constantly, what is? And I would just hammer it over and over again, especially when it came to speeches. Fed speeches were like everything to me, and I would just be obsessed about him. I would read these speeches and go like, what in the hell are these guys talking about? It is like this weird jargon. It's almost like it's written in code or something of that nature. So I kept reading it over and over again, and I'd break it down. I'd read this, little footnotes, and just kept going and going until I realized, man, I'm starting to pick up a lot of what these guys are putting down, and it's not what I'm hearing out there amongst the other economists. It's not what I'm hearing on mainstream media. I literally ended up going way out on my own and kind of developed my own theory that I have coined the credible threat theory, which is ultimately the Federal Reserve using their words more than their actions in order to guide markets. And every day I'm trying to refine this theory to break it down just a little bit better, a little bit more understandable for the average person, to can then internalize this information in a way that they can recognize what it is that's going on with the economy, because it seems to be very counterintuitive to what it is that you would think, and everything that I've learned.
Yeah, that's you've mentioned a few keywords that I've heard you use many times over the years, and it's funny to hear them stick now, and like internalizing the theory. And I feel like I've got to a reasonable point where I understand what you're talking about there. And let me try and sort of put it in my words to see how that is. But essentially, it's not only the actual policy that's going into effect, like whether the rates are going to change up or down or something like that. It's there's a communication strategy that they'll employ surrounding that policy change, and they'll use that communications in a sense to engineer a psychological perspective or a sentiment in the market, which in and of itself does more to change the actions in the market than the actual pricing points of a percentage or a quarter of a percentage point on the inflation. It's the communications and putting that in a concert with some things that maybe generate anxiety or that generate exuberance in the market, and that will create the conditions that were necessary to justify the movement in the pricing points. Like if you want to create, if you want to raise the interest rate because inflation's getting out of hand, that you would do something that stimulates the inflation first to then justify the application of the increase in interest rates. Is that sort of in the ballpark?
Well, I mean, I think as far as your understanding, the way you were explaining it, I think for the most part, yes, you're getting it right, in that if they can project a particular direction for their rates, like, hey, we are going to, if this is needed, kind of idea, and then the markets start anticipating this and then act preemptively for it. And that's exactly right. So this is how, the way the Federal Reserve has worded it, and I believe it was quoted from another economist or central banker, Mike Woodford, who said, not only do expectations about matter, but very little else matters. And now to understand what it really means to have expectations guide the markets, or the expectations that markets have of what it is that the Federal Reserve is going to do, whether it's forcibly guided, like through a forward guidance kind of application, where they deliberately say, hey, we are going to do these particular things, which then has the markets react to those intentions. Or as opposed to, I don't know, we may have to raise rates. It's a good possibility, you know, and then these kind of like vague ideas of what it is that's being delivered. Ultimately, it has the same action within the markets, right? They are going to make a decision one way or the other. Now, I know this kind of sounds almost conspiratorial in a way, but you don't really have to look at it in a conspiratorial mindset. You can really see evidence of it taking place. And for simpler examples of it, as opposed to being more of a macro kind of view of how they operate, is to look back at COVID with the use of the special purpose vehicles. And these are some of my best or favorite examples to use of the credible threat theory, in a sense, because of how well they were able to deploy particular information into the markets, into the economy. So now the idea that they were going to be buying corporate debt, this blew the market's mind. They were like, holy moly, the Federal Reserve is going to be picking winners and losers. And now the way that they established this credible threat was through the use of a special purpose vehicle. Now, the special purpose vehicle could not exist unless of the unusual and exigent circumstances of COVID. So unfortunately, this is not something that they are going to be using all the time, but that they had the ability to use at that particular moment, which is the only time that they would really ever need to use this particular tool anyway. Crisis scenario. So now the unusual and exigent circumstances of COVID said, hey, we need to be able to backstop these corporate facilities, right? These corporate debts. So we're going to buy the fallen angels. Like we're going to buy into some of these ETFs who are essentially holding these corporate debts. And we're going to fund these corporations through this special purpose vehicle. And the markets lost their mind. And I know I was one of them. I was out there on YouTube going, hey, the Fed's picking winners and losers, yo, right? And then spreading this information. Well, the market heard this and said, well, if the Fed is going to be buying corporate debt, then why don't we just front run them? And so that's exactly what they did, is they started buying into this corporate debt, essentially knowing that there was a guaranteed buyer going to be there. And that was the Federal Reserve saying, hey, we're buying corporate debt with this special purpose vehicle set up here. So these corporations were able to get all the funding they needed before that special purpose vehicle was even established. Like they said they were going to do it, but before it got established and funded and all the ability to even buy corporate debt, the markets had already funded all the corporations and they were just gorged on cheap debt, and they didn't need the corporate debt lending facility to do anything except for be there to establish that credible threat. Such a good example of it. Like literally the Federal Reserve describes it themselves in a speech that was delivered by Richard Clarida back in like 2020, I think it was, where he talked about that exact thing. It was just like, it was, these corporations were able to find all the funding they needed before the debt facility was even established. So knowing that they can use particular words and sentences to create market conditions that are in favor of what it is that they need, you start to look for it. You start to look for those things as opposed to what it is that they are going to do, but more of the message that it is that they are actually delivering out there, because it has a profound impact on the economy. And as you start to recognize how it is that this profound impact of information and expectations upon the market starts to move the monetary policy in a way that the Federal Reserve didn't actually do anything. There was no interest rate adjustment, but yet the economy becomes either accommodated or restricted based on where it is that the expectation has pushed inflation. And now that is so strange and hard for people to understand and realize that is what is occurring there, that it's almost hidden in secrecy. Like the idea of the real interest rate environment is something that nobody really discusses. To think in 2020, like late 2021 into early 2020, and you could Google this for yourself. The banks were offering up negative real interest rate mortgages. Now, the mortgage itself was 3.25%, 3.125%, maybe slightly under 3%. But the real mortgage rate that people were getting was negative. And this is so weird for people to think. It was just like, well, what's the difference between the nominal rate and the real interest rate? Well, if the nominal rate that you have signed your loan is at 3 1/8, but there's an inflationary scenario that's running 6-7%. Well, you're actually getting a negative 2 or 3% real interest rate on your mortgage after the inflationary scenario. And this is something that very few people understood what was taking place during this time, but yet you could recognize that something was up. People were bidding houses $50,000 over asking price. How in the world were they doing this? Well, they were being offered a negative real interest rate mortgage. Very few people could understand it. It was never delivered as far as a communication out there to the mainstream media. And to understand how it is that the Federal Reserve used that particular scenario in order to do a reflationary period is something that almost no economist out there in the entire world will ever talk about.
So there was
I know, right? I'm sorry. I just go too deep.
That's great. It's great. I'm just trying to think of how to frame the question from that. So the people who took on that the 3.325 interest on a mortgage, and then the inflationary scenario was around 6% because all the prices were going up because of supply chain disruptions and various other factors, sort of a readjustment of global travel and, whole industries shifting. But essentially, like, those who moved in to take advantage of, who recognized that 3% drift, took advantage of something which is like physical property to move into. So they're buying into the houses. And was it then the buying into the houses that created the gain in the property that allowed them to capitalize on that 3% differential? Because if you take that 3%, but then the property market tanks 6%, even though other markets are inflating, is it just the nature of the supply and demand in property that sort of guaranteed that if they took safe haven into that asset class, they would do well? Or do you think that it's just always a good thing to go into?
Well, no, I mean, I think that's, to each property is unique in the way it is. Like, I don't think it's a guarantee just because you're getting a negative real interest rate on your loan that you're going to automatically just win by buying into the real estate market. Mm-hmm. I think there was particular markets that did exceptionally well by people who were able to take advantage of that particular situation. Not everybody recognized that it was going to work out as well as that did. When property values fall dramatically, then you have an unfortunate circumstances that doesn't really matter what the interest rates are doing. If you can't make your payments on it, then it's an unfortunate circumstance, especially in the understanding you're trying to use this property to make money, and then if that starts to churn on you and you're not able to make money off the property because of the position that you've taken in it, man, talk about getting upside down really fast. But as far as the general person who is taking out a mortgage, they're probably considering what that payment is going to be for the foreseeable future, right? Like, they're thinking, if I can make this payment, then I'm good. Well, if you're in a fighting situation in which that you're trying desperately hard to get a hold of a house, and every time you go to bid on it, somebody else is outbidding you, and you're offered up a really low mortgage rate, right? You may not even understand that you were even getting a negative real interest rate at the time, only to recognize later that the house prices were moving up as quickly as they were. Now, that would be the circumstances that I was facing. Like, at the time, I wasn't thinking, man, I'm getting a negative real interest rate on my mortgage. Now, I knew it was really good, and I knew inflation was running hot, but I was not considering it at the time because ultimately I was looking at it like a wage earner, right? What my payment is going to be. Can I make this payment going into the future? If it goes underwater, can I handle that sort of situation? These are all wage earner perspectives. But when you start understanding it from an asset holder perspective, it's a whole different view, right? Looking at an asset that's gone up in value more than the interest payments, principal payments, and all that. It's like, holy shoot, like, what in the world is going on here? Once you start seeing that, man, being a wage earner point of view on things is going to give you a whole different perspective than being the asset holder point of view, even though it might be the exact same asset, same position, and everything that you have taken with it. I don't have to look at this asset that I purchased like it has a negative or had a negative real interest rate loan. Or even right now, it's essentially sitting at a neutral interest rate. You know, if you think about inflation being somewhere around 3% and the mortgage rate is at 3 1/8, what am I paying? An 8% real interest rate on the mortgage after inflation. So to view it in that fashion seems to be almost like a completely different, like almost understanding of the situation in general. Like, you know, for most people, again, they kind of think about how much is it that I'm going to be making my payment on? How much is this house worth? But very few people are going to look at it going, man, what's my real interest rate that I'm paying on this asset that is growing in value? Or how much is the value of an asset I'm paying a negative or 0% real rate on? So confusing. But once you see it, you realize that's what the bank is looking. That's how the banks are viewing it. So when the people say, man, what is it that they're doing for us? They say that as if they're going to do something for the wage earner. But that's not really what the bank is doing. The bank is looking at the asset holder and what it is that they're doing. And I know, like, at this time, people get like very upset when they hear this, especially coming from somebody who is working class themselves. Like, I stand at a till and I do retail sales for a living. Like, I have a day job, right? But to understand the day job doesn't cut it in this world. And really, when it comes to the consumer, this economy is based around the consumer. Like, who is it that's consuming? Borrowing and consuming, right? And so when it comes to this consumption part of the economy, the worker, the individual, the wage earner, they don't necessarily consume in a way that the bank can even like give attention to. It's just like they just don't do enough of it. But the top 10, the top 20% of households, they do a lot of consumption. So if you're a consumer-based economy and you got a whole group of people out there that really is cumbersome in increasing their consumption, and then you got this little select group of people up here, right? It's not little in the sense, but you got a smaller group of people up here, and those are the asset holders who essentially do almost all the consumption. Who is it that's getting focused on? So understanding that the bank is not looking at this from the wage earner point of view, which most of us would do. How much is my payment? Instead, they're looking at what are we deploying into this economy for a real interest rate? Is that positive or negative? Is that accommodating or restricting? When the Federal Reserve says they are slightly restrictive right now, if inflation was to rise, they would grow accommodating. The wage earner doesn't see that. The wage earner looks at inflation and says that's painful experience. But the bank says if the inflation rises, that's going to be accommodating to the economy. Who's going to recognize that? The asset holders, right?
Anil, do you have any?
I was gonna see if you had a question, but you know, I look at inflation and asset prices like in stocks and real estate increasing primarily due to inflation. And I think like, are we getting wealthier, or is it really just that our purchasing power is getting diminished and lowering over time, right? And are we actually stimulating the economy? Like what actual real value is being added by all of this financial, showmanship kind of thing? I don't know, created the label there, but like it almost feels like a show in a way, because it's really just, there's no real, with all of that movement, there's no real added value, added value into the economy. No, there's no more production in the economy. It's just inflation, and then that gets reallocated into assets, and it balloons into assets, right? And
well, yeah, I mean, essentially, like, we're not a productive nation, right? I mean, we do produce stuff and we sell stuff and we manufacture things. And actually, in the reality of it, we do actually quite a bit of manufacturing. The only problem that we really face with our manufacturing base is that we import a hell of a lot more stuff than we export.
mm-hmm.
And that's really where the dilemma lies, right? Because it comes down to something called Triffin's dilemma. And Triffin's dilemma is something that was actually discovered way back in the 60s. in that if you're going to be the custodian of the world reserve currency, you're going to have some serious issues. One of them is providing the world with that currency. And now here's really where a major problem starts to come up, because we look at the US economy from a really personal, local point of view, meaning like, hey, my inflationary scenario, my job, my business, my thing. But yet outside of the United States, there's all kinds of business that's being done with the dollar. And so when we think about the dollar and what kind of transactions it's doing around the globe, this really isn't up to the United States. Like, we don't have any choice in the matter when two nations decide that they're going to do a deal in oil. Now, a lot of people say we force that upon them, but ultimately they have other options out there. They don't have to use the dollar. They can use other things that are available to do a transaction with. The only problem that they're going to face is that most of the other currencies out there are going to be questionable about whether or not another nation is going to take it. Dollars, guaranteed, no doubt about it. So it does hold that kind of elite position. But on top of that, other nations have done deals in dollars in which that they have written contracts that are due in dollars. Now, this isn't something that the United States is responsible for. We don't have to pay those contracts, and we don't have to provide them dollars to pay them contracts. But those contracts will come due, and they will demand dollars. And when they demand dollars, the demand for dollars will start to strengthen the dollar. And on top of that, those contracts get used like dollars. So not only do these contracts get used like dollars, but then they demand dollars in order to fulfill the contract. So when all these dollars are out there doing transactions that really don't have a whole lot to do with the United States, when they start to come due and the dollar starts to strengthen, this starts to put a huge burden on the entire globe, including the United States. And now this sounds very like kind of strange and esoteric, but really there's a great document from the Federal Reserve called Dollar Funding Stresses in China that talks about this exact thing. Jeff Snyder, Eurodollar University, and Brent Johnson, from Dollar Milkshake Theory, kind of. Those guys, they really nailed this kind of idea down. And it's really important to kind of remember that the dollar itself has demand outside of the United States. So when the dollar starts to then become in that higher demand and the United States needs to fill that demand, how do they do that? Like, how do they fill in the liquidity crisis when it really starts to encompass the world as those dollar denominated debts come due? If it starts to allow the dollar to strengthen, it starts to destroy our economy. Things slow down dramatically. Deflationary pressures start to occur. Unemployment rises and chaos ensues, right? So they tried to keep the inflationary scenario going. But if these dollar demand starts encompassing the world from these dollar denominated debts that are now coming due and they cannot find the dollars to pay them, the Federal Reserve is going to have to figure out a way to provide that liquidity out there to the world. And this is where the quantitative easing really steps in and buys that massive amounts of U.S. Treasury debt. But the Fed has already said it. We can't do this. We did it a couple of times. That's cool. But if we were to continue to go down this operation of trying to buy U.S. Treasury debt to fulfill the liquidity demands of the world, we will crash the United States government. There's no doubt about it, right? They are on an unsustainable debt path. So now, what is it that the Federal Reserve is going to do? Well, if you go and you research back far enough, you're going to find a Ben Bernanke speech. It's one of the only places I can find this information where he straight up says, the Federal Reserve already has the authority to buy the debt of a foreign nation, put that on their balance sheet and issue out liabilities. Whoa, what in the world could that be like? I understand the U.S. Treasury, mortgage-backed securities, gold, maybe a little bit of SDRs, but when they start buying the debt of a foreign nation in order to provide the liquidity to the world, that's going to be a whole crazy place to imagine. So when I think about the dollar losing value, yeah, at times it probably does. And it's probably not a good idea to look at it as a store of value that would hold on to purchasing power, because it doesn't really do that. It's more of a currency. And the currencies meant that it's trading goods and services for other goods and services. And if you just consider it for that, it doesn't killer job. I mean, it does a great job. You can buy just about anything with $1, right? So if you can imagine that being the case, instead of one that holds value, use it as currency. Don't expect it to hold value. Get it into something that does. I mean, I like silver. I like Bitcoin. I like putting it into the real estate in the house. I like buying stocks and stuff. Anything that really isn't necessarily the dollar itself, because unless I have like a plan for it, I don't know what you would do with it.
But
Go ahead, Matt. You got a question?
Because going back to what I was initially saying, and then I'm going to tie it to what you just finished off saying. So you said, put it in something that holds value, and you naturally are going to think of like stocks and real estate because those prices go up. But are they really holding value, and are those prices really going up because their value, over the last 10? I don't know. Let's just take I don't know if you have a good example of like a market, but like, let's say 30 years ago, prices, I don't know what the average price is in the US. Would you say it's like 350, 400, 500? For the US, the average price of a house.
Like how long ago?
Like right now.
Oh yeah, I think it's 400. What, 400,000?
But like 30 years ago, how would you compare it to about like 30 years ago?
Well, yeah, but okay. I mean, are you just considering that a dollar? Are you just considering that like a dollar value that's to the house, which is reasonable if the amount of houses to the amount of people who demanded houses was consistent, right? Then we can look at the dollars and say, okay, well, those aren't buying as many houses, or they buy more houses. But that never stays the same. So population grows, and the amount of available homes or new constructed homes, this is constantly shifting. So to kind of like look at it in that kind of demographic is shifted, right? So it's not the same. And even in that, like, the idea behind what it is that's available to the average everyday person has to be understood, that there's economic forces that are playing out that separate the rich from the poor. And part of those economic forces, and recognizing them, is property ownership, and how that really concentrates into the hands of a few. This is really getting down to the Cantillon effect, and how the injection of new money constantly pouring in, and the people who have first access to that money get to take advantage of it. Well, if you're working to try and do that, you're competing against people who are not working to do it. And so you're like the ability to acquire a house is now competing against those people, where before you could actually build your own house and compete against other people who are building their own house. So you're in a different you're like, again,
what if you use a different asset, let's say like gold or silver, right? Mm-hmm. So my question is more along the lines of, you said at the very end of your last statement where, don't think about the dollar as a store of value, just as a transaction tool, and then put it into something else that holds value. But like, my question is, do these things actually hold value, and are they actually appreciating in value, or is it really just price inflation due to printing of money? Because how much more has gold become valuable than it was like 10 years ago, 30 years? Its properties are still the same. Go ahead. Right?
Maybe if you, instead of comparing their dollar prices, you compare how much gold to buy a house, because that sort of amount has, at least
in a way, it's still related to the dollar.
Infographics, and maybe 30 ounces of gold in 1970 could buy you a family home, and now today 30 ounces of gold can buy you a family home still. So that pricing has sort of stayed the same, and the gold is not necessarily an appreciating asset. It's better off as an inflationary hedge, which allows you to preserve a certain amount of purchasing power against other like assets. But that, maybe you're better to answer that, but maybe comparing against separate assets rather than the dollar to it.
Well, I think there's a speculative idea in there, and then there's an investment kind of idea that's going on within this. And so when you think about like the speculative asset, you got gold and silver, and what does it really do? I mean, you got people out there who will demand it. Like I got this gold coin right here, but it's been since 1800s. I don't know how many purchases it's made, but really over the last few years, it's probably just sat in people's hands and really didn't do anything other than maybe shift, a little bit of dollar value over to other people. It doesn't go into a computer. It doesn't do anything. It just sits here, right? And now it sits on a shelf right next to me, and I get to use it as an example. Now, I can kind of look at that and say, does this thing have value? Did it hold value? Does it create value? Or I can just ignore the silver altogether and then look at this old saw that I have sitting out in the shop that I've made thousands of dollars with, right? And I bought it for $80, a long time ago. And so now the asset of having a saw that can make me money as opposed to having a silver that I'm hoping that will someday make me money, which one of these really has value to it? Like, the silver has value. Obviously, somebody's going to buy it. But does the saw have more value than the silver does? Well, it doesn't have any value if you don't use it, right? Does it have the value of the saw itself? Well, somebody might pay you for it, but if you used it, now they're going to pay you even less for it. So if you use it to make money, you're actually going to diminish the value of the one item that can actually make you the most money, right? And so it's like,
I guess
looking at assets is different.
Yeah, but I guess the like the saw is a little bit different as opposed to like real estate and gold and silver in terms of we're talking about holding value, that specific use case of holding value, appreciating in value. Normally people don't think about, I'm going to buy a saw and I'll buy a bunch of saws, right? So that's what I was going to say. Let's stick to like something like gold instead of a house, because you just mentioned some things about the house that makes it a little bit hard to compare. But like, gold itself, yeah, or silver, they both haven't really changed, but yet the price of it has changed dramatically over 10 years, even within 10 years, right? But it doesn't necessarily mean it's become more valuable. It's just that the dollar has become less valuable over time.
Well, yeah, I mean, the dollar doesn't, but the dollar wasn't like, I mean, the silver generally holds its purchasing power for the most part, right? Like right now it's doing pretty well considering, what it's done in the past. I look at a quarter, like, what is a silver quarter worth today? Like $10 or something like that? I can't remember. And if you remember way back in the day, you hear the old grandpas talking about buying a gallon of gas for a quarter. Well, really, ultimately, that quarter is going to essentially buy you a gallon of gas forever, right? Like it's always done a gallon of gas. It probably always will. And so therefore, the quarter does hold a value against other items out there when it comes to its purchasing power if it's a silver quarter, but not the token fiat currency one. Like that's not the same thing, but yet you look down at them and they're supposed to be the same thing. They're not, right? And so if we were still using silver, then we wouldn't be really even having the conversation anymore about whether or not the dollar is holding value. But again, like I look at it, it's just like, it's not going to. It's like once we switched over to a fiat currency 100% with no backing to it, there's no value to it other than that of a transactional capability, which is great. Do
you think there's a way to go back?
No.
You don't think there's a way to go back?
What?
So, because like we can't go forward with it. It's an insurmountable debt that we cannot, sustain. It's a system that is unsustainable.
Well, we can't go on with buying U.S. Treasuries, but there is the capability of buying that of foreign nations and injecting that money into the economy. And tokenization can be a very good control over that system and how that would work. Now, I'm not trying to predict that, but it seems like they're leading up to it. And knowing that essentially the IMF has already pretty much stated that if you are going to have a cashless society, if you're going to have a negative interest rate, you have to have a cashless society and a tokenized dollar. And now they didn't say it in those fashions because it was before central bank digital currencies and tokenization and all that other stuff. But they knew that if you want to go into negative rates, then you have to get the cash out of the system. And the only way to really do that is with the tokenization. So once it's tokenized, the realms of possibilities really start to expand. And at that point, like, can they keep going? No. I don't know. Like, yeah, I guess they could. You know, at this point, it's just like, holy moly, I've never really ever had this idea that the Federal Reserve would jump into that of a foreign nation's debt in order to provide the liquidity to the world. But with tokenization, that's a real damn good possibility. So knowing that we're not going to go back, like how, like in order to go back, we have to understand how come it is that we lost the ability to even stay on a gold standard. And now this is really where understanding the Cantillon effect is most.
Do tell. I'm curious to hear this because.
Oh yeah, dude, this is my favorite one because I love gold and silver. Like I'm a big fan of it, but there is no way that we're going to go back onto a gold and silver standard. And I'll explain
the story because I guess I don't know the full story, but like all I know are the specific dates. So I think it was like 15th of August, I believe, of what is it, 1974, 9, 3, 1, okay, 71, and that was the Bretton Woods agreement, right?
The ending of Bretton Woods, yeah.
But why did that happen?
Because they had printed too many dollars.
Okay.
Here
it goes down, man. I'm going to tell the story unlike anybody else is going to tell you, and you can go and look all this stuff up for yourself. Most of the time, what ends up happening is that people have a tendency to blame politics on these situations, and therefore it makes it very difficult to understand what it is that's going on. Because the Cantillon effect plays out, doesn't matter who you are, what country you're in, doesn't matter if you're an individual, corporation, doesn't matter. It always plays out the same way, right? So you can take this understanding from a personal point of view and then start applying it to the bigger picture. And it always goes down the same way. First, you're going to rise as an industrious person, okay? Once you have risen as an industrious person, what is the very first thing you're going to really enjoy? Higher standard of living, right? You're going to want to drive a nicer car, wear nicer clothes, live in a nicer apartment, eat nicer food. This is what happens when you get a raise, right? When you earn more money. So if you can imagine the United States rising as an industrial powerhouse, right? We were producing the world's greatest stuff and sending that stuff out there to the world, and the world was paying us gold. This was a great situation for the United States to be in. Now, Cantillon describes it in the exact same fashion, only instead of using production, he describes it with a silver mine. So if a country comes into a silver mine and they are extracting silver out of this mine and injecting this new money into the system, it goes down the same way within the economy. Now, whether it's a silver mine, U.S. Treasuries, freaking taking it through war, right? It doesn't really matter. Debt issuance, it all kind of goes down the same way. New money is injected into the system. Now, the United States was in a really wonderful position as the world's greatest powerhouse, producing that stuff, sending that stuff out there to the world, and the world sent us their gold, and we raised our standard of living, right? Single income, provided enough for the house, the wife, the kids, the retirement, college tuitions, all the stuff. It was a single income. Why? Because we produced really good stuff, sent that stuff to the world, and the world sent us gold, right? Once we had the gold, we had a very high standard of living. And this is really where the problem comes in, because Cantillon describes this from hundreds of years ago, before there was even a United States of America. He describes this. Once you have risen your standard of living, you will start to import foreign production because they produce it cheaper than you do. They don't do it as good, but they produce the same stuff that you're doing. They're going to do it cheaper, and people are going to say, yes, I want your cheap foreign production. It becomes very obvious that the new foreign production comes in and the domestic manufacturers leave. The more the new money pours in, the more this takes place where the foreign production comes in and more the domestic manufacturers leave. This is going to start driving the wedge of inequality, because the people who are working those awesome jobs are now finding those awesome jobs leaving. This wedge of inequality will grow deeper as the new money pours in, and the people at the top, the asset holders, get a hold of that and spend that money on that foreign production, which is now coming in, driving that wedge even deeper. So as we come to this situation in which that we had imported all the gold from around the world was saying, you know what? You're done. We're not buying any of your production anymore. And the United States was like, wait a minute. We're going to have to relinquish this gold if you're going to be buying more of our stuff. But you know what we could do is we can print up dollars and they'll be as good as gold. How about that? Then you can continue to do transactions. And the world says, no, That was terrible. And the United States says, well, what else are you going to use? And the world said, nothing. Well, then you starve. Well, the world didn't want to starve. They wanted to do transactions that they didn't really care that they were putting up this money. So as long as they knew that they could trade those dollars for gold. So the United States could freely spend money like crazy out there, buying all this production of all the world with essentially fiat currency, because the people knew that they could trade it in for gold until the day they couldn't.
Yeah.
And at that point, we severed ourselves from the gold standard, and our standard of living just shot right through the roof. Now we import a hell of a lot more stuff than we ever export. And if we want to go back into this position in which that we can import the gold again, that means we have to export more than we import, which means our standard of living goes to shit, right? And you tell me, like, how good of a position is it going to feel to lessen your standard of living, sleeping on the ground so that you can compete against that other dude who's manufacturing stuff that you want to manufacture? It's not going to happen. So no, the wedge of inequality is going to get deeper. And if you're not positioning yourself into assets, you're going to miss it. Wage earners will be left behind, guaranteed. No doubt about it.
Yeah. So
sorry, man. I know it's like overwhelming the way I kind of say it and stuff, but it's really the facts of it. Cantillon essay on economic theory. They're like, if you ever take a half an hour, well, that's probably going to take took me a little bit longer than that. You could probably get it knocked out in a half an hour. But there's 3 chapters. The increase and decrease of money to the state. So Cantillon essay on economic theory, right? You can go and get it for free. The PDF's over at the Mises Institute, right? Cantillon essay on economic theory. And then you go to part 2. There's 3 parts to the essay. Go to part 2, chapter 6, 7, and 8. Read those chapters like 2 or 3 times, and dude, it will blow your mind. It will be like, man, there is no way in the world that we are going back to a gold standard, and there is no way that this wedge of inequality is going to lessen. It is going to get worse by far until there's a complete and utter collapse. Because once the new money turns off, everybody falls into pain and misery. Now, that's where you want to be, like in your gold and silver, or even Bitcoin to a lesser extent in that sense, because it's outside of that third-party risk. And that's really where you can only place that you can ever really get to, because everything else is part of that third-party risk. It's all tied to the dollar. It's all tied to their laws, their, property rights, all that other stuff. The only thing that can get you out of that is a physical holding of a property, such as silver, or in the, like I said, a lesser extent, Bitcoin, because you're still relying on the system in that unique position, but it still holds the properties of being outside of the third-party risk, right?
Interesting. You can actually hold, like, Bitcoin is actually a bearer asset, just like gold and silver. Is that correct, Todd?
In all intent and purposes, yes.
Yeah.
And while there's a network, while there's an internet, and while there's power, it's the bearer.
Exactly. Yeah, that's right.
Whereas the other ones are more of like a physical commodity rather than a digital commodity.
Yeah.
I had a guy give me a Bitcoin token that had a little decal on it that had like essentially the public key on it and then a private key underneath it. And so you have to kind of trust that person who issued that little token, that they didn't compromise that private key. But this is pretty cool because now it's like a physical token. Like it's not really, you still have to have access to the internet, but it's a silver coin, essentially a silver token, real silver. So it has that kind of value to it, which makes it kind of cool. And then it also has the private key within it too. So you can continue to load this thing up and essentially have it on a physical piece, which I think is kind of neat in itself, but still at the end of the day, it's on the computer somewhere, right? It's out there on the blockchain. You just have to access it again. But I think that's pretty cool to kind of have those kind of little pieces out there that say, hey, there's so much Bitcoin on here. You can check it, make sure that
there's mechanisms to do. It depends on your trust threshold, So when you said you got to trust that they didn't tamper it, but if my friend gives me $50, to pay for fuel or something like that, I don't get the pen out and the special check the $50. I just trust that's the bill, and so there are ways to create an offline transaction where you've got a signed, you sign the input, and you could actually, there is the mathematics that allow you to do ECDSA, which is the elliptic curve digital signature. Like, it will take you a long time, but you could do it with pen and paper in essence,
No way.
sign a transaction and move it along, and then you've got, oh, now I've got a signed input that I can, you know, process if the network comes back up online. So there are means to do that, and you can create what you were talking about before, like tokenized assets. So there's, you know, bonds and things that can be transferred as a tokenized asset that have we're used to thinking of it in a dollar value, but if you think of it in a basket value, and is that equivalent to another basket value, you might use the dollar to bridge those for a period of time. But as we move into a future, these, you know, wrapped funds and such can have a level of equivalency in a market themselves. Would you imagine something like, if you were talking about the tokenization as being the tokenization of real world assets and that being the escape raft, moving into something cashless, we're not using cash anymore, but there's still an accounting system between the two. Is that going to be dollars of the value, or would there start to be more pairs,
other forms of
and distributed sort of?
Right. Well, I mean, I think kind of like the idea is like, can you actually circumvent the dollar doing this?
But yeah, potentially, or is the dollar is just a number, isn't it? Like, it's once you're going cashless, the dollar is then, it doesn't represent a dollar note. It just represents a record in a database. And if you can have a stability and a pairing of something to something else, does that, you know, start to?
I mean, you know, to be honest, like, I don't really look at the dollar maybe like that as much. Like, you know, what really does transactions around the world is U.S. Treasuries.
Mm-hmm.
And when people are wanting to do dollar-denominated trades, they're generally not doing it in dollars. They're usually doing it in U.S. Treasuries. So if you want to think about, like, how can you increase transactions around the world, you have to increase what it is that people feel is a safe and liquid asset. And this is really where U.S. Treasuries dominate over everything else, because there's really nothing else out there that is as safe and liquid as a U.S. Treasury is. And this is really like kind of almost like the poison within the system that is going to make the continue on and eventually kill it. Is that if you have to do a transaction and it's essentially done in dollars, most likely you're not going to want to use the dollars themselves, because dollars are cumbersome, right? There's transaction fees and all kinds of stuff. But if you're doing the transaction in U.S. Treasuries, well, then you actually get a little bit of an interest payment on it, because holding the U.S. Treasury at least provides you with a little bit of yield, and it can perform the transaction as well. So generally speaking, most people are not doing transactions in dollars. They're doing them in U.S. Treasuries or some other dollar denominated debt. And now this is like the important kind of feature of it, is that the only reason why they're doing it is because it's the deepest, widest market. There's nothing else out there that even comes remotely close to it. And although there is other forms of currency that can occur out there, at the end of the day, they're going to want something that is going to end the day with something that is very liquid, not something that is going to be cumbersome. And so this is really where, like, until the death of the dollar exists, replacing it is going to be a very difficult, burdensome thing, especially if you try to replace the dollar with something that's a good currency. Like, if you have a better way, something that is more desirable, something that is like catching the interest of the individual that says, man, this is a better way than the dollar is, what's going to end up happening is something called Gresham's law is going to start kicking in. And now Gresham's law can really be accounted for way back in, like, I think it was like the 14 or 1500s or something. And this is where the idea of coin clipping came in, where people would clip the edge of the coin and keep a little bit of the metal for themselves and then spend that coin at face value into the economy. What Gresham had noticed is that the clipped coins were in circulation, but unclipped coins got hoarded away, because those unclipped coins were good currency and the clipped coins were bad currency. And so the bad currency goes into circulation and the good currency gets hoarded away. And now another way to understand this is kind of just look at, like, just dealing with me, you know, you want to buy, you know, this here, I got this mouse for the computer and you want to buy it off of me, and you come to me and you're like, dude, what will you take? And I'm like, oh, I'll take whatever, man. What do you got? And you got like, well, I got the dollar and I got this here gold coin. And I'll be like, yeah, I'll take either one of those. Now, are you honestly going to hand me that gold coin? I mean, is that something you're going to do, or are you going to keep the gold coin for yourself and you're going to put the dollar into my pocket? Because I tell you what, if you give me the gold coin, me as the merchant, I'm never going to give it up and you'll never see it again. So somebody's going to end up hoarding that gold coin and the bad currency is going to get put into circulation. And this is the unfortunate consequence of Gresham's law. And the idea of trying to introduce a good currency into the system is that introducing a good currency means that it's essentially going to get hoarded away, or it's going to have to move towards something that is the most liquid thing out there. And this understanding of these two that combat each other is really difficult. But once you kind of grasp it and you're like, man, yeah, I wouldn't give up my gold coins to put into circulation if dollars are going to get accepted. Like, I'm going to keep my gold coin, right? So therefore, good currency won't show up in the economy, and nor will a good idea for a good currency can show up in the economy. Yeah.
What about if the good currency can get you things that you can't get with the other currency? So it allows, it's divisible into a smaller unit. So let's say micropayments. With a good currency, you go, oh, that's better than fiat. I like it. I'm going to hang on to it and hoard it. But then you go, but I can actually participate in a way where I can get access to services that I couldn't get by spending, the crappy fiat. I can start to, pay for to send an email, and that email service provider now doesn't have to steal my data to make money, because they're able to monetize it on a smaller level. But that is only accessible by use of something that supports that is divisible into such a small unit and can be used with such a velocity that it's churning rapidly. So there is a market for the good currency to show its benefits and its strengths that sort of outweighs the preference for hoarding it.
Okay, well, I kind of understand the hypothetical to it, but I guess the circumstance in which it is that you would be able to say, you cannot purchase this with this fiat currency and you can purchase it with this tokenized currency is probably going to end up being a very difficult economy to operate in, because everybody's going to want the same currency, right? So ultimately, this person is just like, well, I got this tokenized item here that I need this particular currency for, and they don't get to do the sales because nobody has it, right? There's only a handful of people who actually have that currency and willing to use it. Now, if you kind of think, man, if this was very popular and used, then ultimately what's happening there is that the original bad currency is losing value to the point, not necessarily purchasing power value, but losing value in the idea that it will even perform a transaction. And in a sense, the bad currency has completely failed. That's when something else kicks in, and that's Thier's law. And it's kind of the complement to Gresham's law, in which that Gresham's law is saying that if you have two currencies, a good currency and a bad currency, the bad currency is going to be the one that's used and the good currency is hoarded away until the bad currency collapses and nobody uses it anymore. Then the good currency kicks in. This is Thier's law. But the first one has to completely collapse and nobody use it. And that's the important feature of it, is that everybody wants, everybody's pay taxes, everybody's, W-2 is attached to it, every stock portfolio is getting paid in dollars, every dividend's in dollars, all of it's in dollars. And so until that system completely collapses and people are not willing to accept the dollars anymore, then Gresham's law is going to kick in. But when it does happen, Thier's law kicks in, and then the good currency is able to step in. But the dollar has to completely fail. Literally the buckets of wheelbarrows fires and stuff like that, throwing it into the furnace.
According to Robert Kiyosaki, the dollar has already failed every year in the last 10 years. He keeps saying the dollar is going to fail, is going to fail. When do you think the dollar will fail?
I don't know. If you were to ask me that question, say 15 years ago, I would have said it would already happen by now. So I had to really change the way that I look at the economy, look at how it is that the Federal Reserve operates and what the dollar is really doing as a world reserve currency. Because the idea of a dollar failure is probably so far off from happening that it would probably I just can't even imagine that scenario taking place anymore.
What would
Like
have to occur for the dollar?
what's that?
What would have to occur for the dollar to fail? I'm asking this because like
Okay.
you could look at other countries and you could see that they're actually historically all fiat currencies have failed historically, 100% of them.
How many of the fiat currencies have achieved the world reserve currency status like the United States dollar has done?
Yeah, that's a good point. There's a distinction
Not
there.
even close. Like
Yeah.
they kind of build their own nation and that's it. That's as far as they get.
Yeah.
But you're providing the world with a reserve currency and you're a fiat system. You're not playing the same game like the Zimbabwe Republic was. Right?
Yeah. That's a very good point. Nobody actually makes that that point is brought up.
No, it's because most people are trying to sell an idea,
Gold, coin,
gold, whatever, they have, and I don't really have anything to sell. The only thing I have to sell is my theory, and that's it. And so, like, whether you use it to buy gold and silver or start a business or whatever, that's up to you. But I don't really have anything to sell outside of what it is that my understanding can provide to the average everyday person. And when I think about the situation we now face here, when it comes to a dollar collapse, like you were saying, what is it going to take? Okay, well, this is what it's going to take. It's going to take the United States to actually go into like some really fiscal good responsibility, right? What they're going to have to do is they're going to have to cut back on providing, the entitlements and all that other stuff. Take some serious hits to it. Now, what this is going to do is it's going to start paying off the debt. The moment that you start paying off debt, you're going to start removing dollars from the system. What this is going to do is it's going to drive the dollar value to the damn roof, and there's going to be massive bankruptcies and famine and depression and horribleness that occurs on account of that, because people who have been promised to get paid will not get paid. And that's going to mean retirement funds. It's going to mean all the stuff, right? Everybody is going to lose out on everything. And now when that happens, you're going to see the dollar strengthen to a way that nobody would have ever imagined. And if you're holding cash, you are going to be a supreme leader, because people are going to want that cash to pay off the debts, because the debt issuance isn't happening. No new dollars are coming in. Debts are being disappeared. That's pulling dollars out of the system, and the dollar is strengthening like crazy. Now, if you can get in on that moment and position yourself into assets right when those dollars are strengthening up during that time, it's going to be very chaotic and people are not going to understand what's going on, but you can do quite well, because once that complete collapse and all that debt and all that crap is all over with, the remaining dollars that are out there, which probably won't be very many considering there's more debt than dollars, whatever is remaining is going to come flying back to the United States, and they're not going to have anything to really want from the United States, and they will dump it all in there. And that's when that hyperinflationary scenario happens. But I can't see that taking place. I just literally cannot find that in the reality of it, considering that if you were to go through all this bankruptcies, you would send the dollar strength into such a high level that it would be completely opposite of the idea of a hyperinflationary scenario, until, right, all the debt was cleared out, all the bankruptcies happened, and whatever few dollars are left over, which I can't imagine being any, right? Like if there's more, if like they use the debt to issue dollars and then there's more debt than there is dollars, all the dollars will disappear, but there's still debt. So at what point does the dollar actually get to hyperinflate? It doesn't. All right. So here it is. The Federal Reserve is desperately looking for a place that they can find an asset to purchase that is not the U.S. Treasuries, right? Because those guys are on an unsustainable debt path, but they're going to have to figure out a way to inject liquidity into this economy. Well, what is it? What asset can they buy? It's just like, to me, I'm like waiting. I'm like, what are you guys going to do? Right? Are you going to force the United States into more debt issuance so you can provide the world with the liquidity by buying an asset? And the really only asset that you have right now to buy of any kind of substance is the U.S. Treasuries. Well, once that is no longer an option, what is their option? Like people keep saying gold and all this other stuff, and I'm like, no, that's gonna totally destroy our own economy. That ain't gonna happen. It's got to be debt issuance that they buy. They got to buy the debt of another nation out there, and that's the only option they really have. And that's why I think really the tokenization, stablecoins, and all that other stuff are taking off. It's because really once the Federal Reserve, like if you have stablecoins in the system, and they are being backed by dollars, right? So essentially a stablecoin issuer is using short-term treasuries of dollars to back this stablecoin. Anything that the Federal Reserve does for a monetary policy transfers right into that stablecoin. Now, this is awesome because the Federal Reserve doesn't even have to regulate this thing. They can leave that up to the government. They're like, hey, that's your job, right? We're just going to handle our monetary policy like we normally do. And then you guys, the government, regulate them stable coins over there. And as long as they're backed by dollars, our monetary policy will transfer right into that.
It's interesting. There's I'll give a plug to another guy in our sort of community, Kurt Wackett Jr. So he's been doing a deep dive into the history of Bitcoin, and where coming from. I think he starts basically with the 1954 citations in the white paper, coming all the way through to the modern age, and he's covering now really some of the questionable separation of concerns and conflicts of interest with say Howard Lutnick and Tether and the Treasury T-bills going in there, and how it's all looking. And that's an interesting can of worms to start to like inspect when you go, wow, they've got more T-bills than many other nation states. I think they're in the 10th or 13th biggest holder of T-bills in the world. And they used to have a clause that said they were 1 for 1, but now they don't. And there's suggestions that they have other liquid assets that can be liquidated to let people redeem in time, but some of that is commercial paper, and you don't know the rating on that paper. So I do think he calls it the Tetherall Reserve, which is an interesting little it's illustrative and sets your mind in action. But we're saying perhaps that mechanism is the means by which they can shift the reality, or kick the can further down the road or something like that. But there's even more opacity in those markets and less auditable and less
for me, the whole tokenization is all about going into negative rates. It's about negative interest rates. That's really what it comes down to. For a lot of other people, it's going to be about taxing and tracing and controlling and, doing that kind of thing and manipulation of such fashions. And don't get me wrong, that's probably going to be part of it too, but that's not necessarily like the key feature of what it is that the central bankers want from a tokenized currency. It was already stated, I did a video in the earliest days of me starting my channel, and it was called Negative Interest Rates Requires a Cashless Society, or Cashless Society Requires Negative Interest Rates, one of those two. Anyway, it was a very short 2-minute video, and it literally is pulling an IMF blog from 2016, 17, somewhere around there. It's talking about going into a negative interest rate, like the central bankers taking their interest rates below the zero, below zero, and going into negative nominal rates. And they said the issue that you're going to face, and that the central bankers are going to face, is that the moment that you apply a negative interest rate to a bank account, people are going to lose their mind. They're going to pull their money out in cash, right? Because why would you keep your money in the bank if it carries a negative rate? At least cash has zero interest rate to it, right? Even though it doesn't carry a rate, it carries no negative rate to it. So holding cash would be the preferred option in a negative interest rate environment by these central banks. So they said, you're going to have to carry two currencies. You're going to have cash, and you're going to have to, what they referred to at the time as e-currency or electronic currency, because they didn't have a name for it at the time. They didn't have central bank digital currencies. They didn't have tokenization. So they had this e-currency option. And now the idea behind having the e-currency is that if you have an e-currency in the banking system and cash outside the banking system, you can apply a negative interest rate to the e-currency. Everybody will pull their money out in cash. So not a problem. You charge a fee for the withdrawal and the deposit on cash. That's equal to the negative interest rate on the e-currency. So it doesn't really matter if you have cash in the system or not. You might be able to use it amongst yourself, but the moment that you take it to an institution, you're going to charge the fee for it. So holding cash is going to be very burdensome, and it'll be forcing people into the e-currency. Once you're in the e-currency, you can start applying the negative interest rates. Well, what's going to happen once you start applying negative interest rates to the e-currency? Force people to spend the money, or invest the money or get it out of the banking or, whatever. So now you got a manipulating system that you can handle within the e-currency that can actually take the nominal rates into negative territory because the people simply cannot get their money out in cash, and it'll force them into whatever direction that they're essentially providing loans for. Now, I know that seems kind of odd and difficult to kind of internalize on it, but once you kind of see that the Federal Reserve and most central banks around the world literally have no ability to stimulate the economy with the lowering of rates, that doesn't seem like real for a lot of people, but that's the reality of the situation, is that even if these central banks were to take interest rates back to zero, they could not stimulate the economy unless they had elevated inflation happening at the same time. That is not a real thing. Central banks do not drop their interest rates to zero during elevated inflationary times. So to understand like the situation that they face is really one of a low neutral interest rate that's too close to the lower bound of zero that still exists today. And now, if they were to lose the inflationary scenario, the only real way of stimulating the economy is to take those nominal interest rates back into negative territory, which is, or not back, into negative territory. And there's no real operational tool to do that so long as cash is in the system. And that's why I feel that they're developing these tokenization and the stable coins and all that, is so that they can eventually go into this negative rate and remove cash out of the system. Or even if the cash wasn't there, it doesn't really matter because they're just going to charge a fee for it. Now, that isn't necessarily something I see in the imminent future, but at some point when the inflationary expectation is lost, that will be the case. But so right now they got the inflation and they're good. They got elevated inflation and they can, kind of operate their monetary policy in an elevated interest rate form.
I think most people, just imagine that the inflation's here to stay for no one that I've had conversations with or heard anyone sharing any sort of, insights that inflation's going to be able to be managed or curtailed in any way. So I think at least for the short term, near term, it's that expectation of inflation is going to persist.
Right, which is actually to the Fed's benefit. So the Federal Reserve actually is more in fear of deflation than anything out there. Inflation is not their problem. They like inflation. Inflation is just fine. It's the deflationary environment that they don't know what to do with because they don't really have any real way of stimulating the economy anymore. And so as long as you're in an inflationary environment, you're all about preventing the inflation, but not trying to create it. And if you're trying to prevent it, that's so much easier than trying to create it when it's just not available to. Think about it. They took the Fed's balance sheet of $850 billion during the Great Financial Crisis to over $4.5 trillion and failed to produce an inflationary scenario. That is unreal to think. Most people will then give it excuses saying, well, there was plenty of inflation. You just have to look in the right places. That's fine. But the Fed and what it is that they wanted for inflation failed miserably. And it was massive quantitative easing that they had injected into the economy. Now, something very interesting has taken place right now. And if this is something that I even just kind of came across over the last few weeks. And really, I kind of started stumbling across it a few months ago, but really didn't quite grasp what it was that was taken off until the task force on communication came out, and then it became very clear to me. And now there's something called Neo-Fisherism, which is this really weird way of looking at the economy. But to understand that if you lower the inflation expectation, you will raise the real interest rates, further diminish the degree of monetary stimulus and make the downturn worse and reduce inflation even more. And that scares the Fed. So again, lowering the inflation expectation raises the real interest rates, and that is a problem for the Fed. If you look at it backwards, if you raise the inflation, you lower the real interest rates and you increase the degree of monetary stimulus. So this really backwards way of looking at the economy is saying that if the Fed sits still and you raise the inflation expectation, you can actually ease the economy, not by moving the Fed funds rate, but by pushing inflation expectations higher. So now with this expectation of the Fed fund, or with inflation running higher and the Fed sitting still, they have the ability to now either be restrictive or accommodating within the economy by adjusting that inflation expectation and what it is that people are feeling about it going into the future. Weird thing about this, right? The Federal Reserve had a reflationary period that they were trying to go through. And this is something that, what's her name? Lord, I can't remember her name right now, but it was given in a Fed speech where she was literally talking about this reflationary period with supply shocks to the economy. Now, what we've experienced over the last few years is one scenario of inflationary pressures after the other. Started with COVID, went into tariffs, we got war, we got energy crisis, Fed independence, whatever. It's one scenario of inflationary pressures after another. Very, very interesting feature about the economy is if you keep the nominal interest rates elevated for a significant amount of time, inflation will start to find the equilibrium up to the nominal rates. People will become more accustomed to the rates. They will demand those rates. They will expect the rates, and then therefore those rates will become more locked in on the economy. So as that inflation expectation is essentially locked in at 2%, the reality of the situation is if the nominal rates, the Fed funds rates, stay elevated through one scenario of inflationary pressures after another, the Fisher effect, the Fisherism, will then eventually kick in and find inflationary pressures just because of the equilibrium effect of the inflation to the nominal rate, so long as it stays within the economy for that amount of time. Now, I know that's difficult, but to think about it again, if you raise the nominal rates, keep them there for a significant amount of time, inflation will find the nominal rates. How do you keep the nominal rates there for a significant amount of time? Have one scenario of inflationary pressures after the other until it can finally kick in. This is the situation we now face. So as the Fed is saying, well, we're going to try and bring inflation down, you bet your bottom dollar, Neo-Fisherism is kicking in right now and doesn't give them the opportunity to lower inflation, because that came from back in the day when the shocks were kicking in and then eventually brought the inflation up to the nominal rates. Neo-Fisherism is difficult to understand, but this is really how the Fed is looking at it. And their little communication task force, they're all about this. They know it.
So before you were talking about Gresham's and what was the other one? Thier's law or Thier's effect? Or something?
There's Gresham's law and Thier's. Thier's law, which is kind of the opposite of Gresham's law.
So do you think, there's terms that have been tossed around as, a great reset or the, financial reset or, not, I'm just aware of the narrative, not necessarily attached to it at all or whatever, but of say like a quantum financial system or, people getting UBIs and things like that. Is there a situation that you could envision where you have Gresham's law, in effect, but Thier's law comes in and instead of it being a collapse, it's more like pulling the tablecloth out and everything still retains intact if there is like a rollout of, I don't know, an alternate system, or if a competitive asset class became like viral in a sense, or it's just its value proposition was so great that could that happen at a pace that's rapid enough that it wouldn't lead to, food stamps and poverty and homelessness? Like, can it be done with grace or anything, do you imagine? No.
Unfortunately not. Like, even if you were to apply like a UBI concept to the economy, and like, you're injecting money into the lower hands and say, here's some like, living class, money for you or whatever, and like you can just go and make it with it. The problem with it is that what you're gonna see is that it's generally the behavior of people who don't understand what they're doing with the money to begin with, and that's why they're poor, right? And it's something that I had to accept for myself, right? And then once I just admitted this, like, to myself, it's my own fault. I did this to myself. Okay, now what can I do about it? Generally, if you were to hand somebody some money, right, who knew what to do with it, they will probably be in a position in which that they have already done something with that money, right? Like, they're already in the stock market. They're already in business. They're already doing something of this nature. If you hand somebody money who doesn't do that, they're probably going to spend it, and that's it. So now here's the unfortunate circumstances of handing a bunch of people money like that, like in a UBI process. is that you can already see like the events that had taken place during COVID was the very short, like kind of anomaly in which like inequality kind of shrank. It didn't really shrink, it just stopped growing, right? But we had like this kind of rise in household savings that kind of diminished this inequality a bit, but it really didn't do that in any kind of significant fashion. It more just slowed the pace. But the point being is that there was a moment there in which that a bunch of money was injected into the households. Like they got it, right? They had been loaded up. They got the enhanced unemployment, stimulus checks, whatever. Their household savings increased dramatically. And a lot of people saw that and they recognized and they said, boom, look at this. This is going to lower the inequality. What happened right after that? Inequality got on a rocket ship, right? And the rich got way rich because the poor don't know what to do with the money. And even if they held on to it for a short amount of time, they eventually nickeled and dimed it away. And if they don't have it, who does? Right? Because if the poor don't have it, somebody's got it. And if the poor don't have it, the rich do. And so the rich got all the money because that's how they position themselves, and the poor don't know how to do it. Now, don't get me wrong, man. If you were to take like all this UBI and you gave it to the people and the people were like, I'm going to pay off my debts. I'm going to start figuring out how I can get a return. I'm going to start figuring out yield. I'm going to be starting business. I'm going to go back and get education. Like this is what their intent was. Well, we might find something in the economy that might resemble that hypothetical situation of being better, right? But that's not what's going to happen. We know this because we can already see it through witnessing what happened during COVID and just about anybody out there. Like I have a friend of mine, we talked about this on my community channel the other day, talking about cars, right? New cars and how expensive they really are. And somebody on the community had said a friend of theirs just came into $60,000 and asked him, what should we do with it? And he says, I know you study the economy, you look at it, what should you do? And he says, like, well, here's all these options. Dividend paying stocks might be a great way to go. And he suggested, in this fashion. The guy ended up going and buying like a new Camaro or something like that, or a new car, spent all his money on it. And I think to myself, like, that is very typical. And when he asked him, why'd you do it? He says, well, I wanted something to really enjoy in my life. Like, I don't know how many times I'm going to have the opportunity to really enjoy something like this. And so I took my opportunity to do it. Right? So he justified it, self-justified into buying this fancy purchase, right? He didn't self-justify him into getting paid dividends on a dividend-paying stock. He didn't justify himself into getting a business started. He didn't justify himself into those things. He had justified himself into a luxurious experience. And that's what the majority of the people will do. Like, luxury is by far the most greatest pleasure a human can enjoy. They love luxuries. And the one thing that they really hate is to lose their luxuries. It's like, man, to have to reduce from a house to an apartment is one of the most painful experiences. To go from a fancy car to a beater car is one of the most painful experiences. Sure. And so when you give the people the opportunity to elevate their standard of living, they will dump the money into luxurious experiences and deny themselves the ability to actually acquire assets to put themselves on the other side of the wedge. So it'll actually drive inequality worse. UBI will make the problem far worse.
Yeah, that's not surprising.
Yeah, I'm sort of, but plenty of people who they want it because they just whittle it away and get a premium Netflix subscription or it just all trickles up into the, and that's like you've talked about the K-shaped economy before, and you're in retail lumber, and at the moment my bread and butter is handyman work, and it's funny because I get a lot of leads, and there's clearly two different types of people that are looking to get work done. There's people that want it done now. They don't really, you tell them the price and they're like, fine, great. And the price that you offer them is twice the price that you offer other people who still say that that's too expensive, but they want it done, now and fast and good. And you're like, if you can just get the people that have the money, and you go to their house. Like I was working for a guy the other day, and he's got, like a full paddle shift Range Rover sports model, a Ferrari 788, and another like sports car there. They're like right on the water, and they're just like, yeah, cool, great. Here's the job. And then other people are like, oh yeah, how much to do gardening or something, and you'll say the price, and they're like, that's way too much just for like, back-breaking work. I worked, it wasn't as painful. I was building some shelves, and it was measuring in that the rich people's joint, and then the other people, it's like digging out invasive weeds and busting your guts, and they want you to work like half the price of the other one, and you're like, okay, there's definitely two systems running in parallel, and some people are very comfortable, and other people are, finding it hard to make ends meet.
Yeah, it's really a two-tier system that has taken place, and it's really becoming more evident as time goes on. Just like even like what you were saying there, like I have a customer who is resiting their house down in Cannon Beach. Now, Cannon Beach on the coast is like ritzy. This is where like, Cannon Beach is where like famous people will buy a vacation rental to get away from the crowds, right? They'll go to Cannon Beach. And so when I heard that, this contractor that I know, my customer was doing a job down there, and I'm like, all right, man, right on, good score. That's a good customer to be working for, because they got the money they're going to pay. So part of the new codes around here is that you have to have a standoff away from the structure of the building and the siding, so it creates like this vapor area. Oregon's really strange, and so they came up with like ways of dealing with this. They got like different house wraps and plies to meet the code. But one of the operations that one can go with is literally tacking up strips of plywood up on the house and then nailing your siding up to that to create this air gap, right? Now, this is the method that they chose to go with, which isn't like, to me, I'm like, really? You could use the vapor barrier, which is like 5 times easier, right? But no, they want to go this other route. So the material that they chose to use was marine grade plywood, which is about the most expensive way you could ever possibly go about purchasing plywood to put on this house to essentially cover it up with siding. And so I'm asking the contractor, I'm like, why are you getting the marine grade? Are you anticipating going to sea or something? Like, you don't like, there's not even a concept of failure within this structure that you would need to have marine grade plywood as applied to this house. Like, it doesn't make any sense whatsoever in any kind of reasonable story that you could tell about weather damage or something. It doesn't make sense. Like, you could go with pressure treated plywood, but even just regular plywood would totally work in every application known to man, right? But he took the idea, what it was that he was buying, knew it was superior plywood. I mean, it's for marine grade application, and he can see the ocean, and that was his only justification he needed. So he bought this incredibly expensive plywood and then ripped it into these little strips and nailed it up on his house and then covered it with siding. And I'm like, all right, these people will make decisions that don't make any sense whatsoever. Like, none. Even after it's totally explained to them, they'll still do it,
Well, there's definitely that total decadence and luxurious. Right. But the thing I noticed with the other guy is he just seemed, with the guy that had the money, like they seemed organized. They seemed like they said, we're coming this day, and he's really good communication. And he said, my wife's got all the materials, we've had them delivered. They just project managed everything, and they just needed someone to come in and do it. And the other people are like, they have no idea even what they want in the job. Like they just want you to come in and make everything better for them, but they haven't done anything to help themselves. They haven't helped you help them. There's a different class of the way that they're doing business, which I think translates into professionalism across the board and that level of organization and structure. And
it's kind of like, it's really fun studying economics as much as I have, and then being in a business like building industry, like the building supply industry specifically, for all the years that I have in the one location that I've been in, because Astoria has really evolved. Like, when I grew up here, we were a logging fishing community. That's what we did. Like, that's where the new money came from, was from logging operations and commercial fishing operations. And so all the homeowners around here and all the properties and all the things that catered to that industry, right? Or to those industries, because that's where the new money came in. We have completely evolved away from that. And like, logging and fishing still exist here, but it's a much smaller component of our overall like economy that's going on as far as the traffic here goes. We got huge, like massive hospital district, like in a way that, like, when you see this new hospital, it's like, what in the hell? Like, this is ungodly hospital inside of our little tiny city. And I'm like, oh, they're getting ready to like basically service this entire corner of the Northwest up here, like on the coast. Like, that's why they have such a facility they're going. And it's getting bigger and more obvious that there's retirement communities showing up, remote workers that are showing up, like these essentially like higher affluent people selling their expensive places and retiring up in beautiful Astoria. And it's completely changed the community around here. We never had homeless when I grew up. There was one homeless dude, his name was Lance, right? Everybody called him $2 Lance because he would always ask you for $2 so he could go down to Burger King and buy a Whopper, because Whoppers were $1.99. So he was $2 Lance. Everybody knew who he was. Now we have entire blocks of tents and homeless community that is just pouring into the streets everywhere. And we are now in Astoria, in the Clatsop County area, a state of emergency on account of the homeless crisis that is now taking place here, which never existed when I was growing up. So as I'm watching the homeless crisis take off and this huge luxurious experience that is now coming to the Astoria area, I'm literally standing at work as they lift a fireboat that just retired from Portland over the top of a brick building and placed it right along the street, so that the museum has this beautiful sight coming. Like, when you come into Astoria, you see this beautiful sight of this big giant fireboat and a pilot boat next to it. And then you got this big giant museum that just got built there, and all this massive amounts of money that is getting dumped into it. And you can see the camp, like, just beyond that, essentially. It's like, wow, it's pretty obvious what separates the rich from the poor. It's luxuries, luxurious experiences. And the more you start to see it happening, the more that people jump into it, the more wedge of inequality is going to take place. The harder it gets for people to live here. I essentially could not live in my own town that I grew up in if I did not have the YouTube channel. I would have had to have left. And that is scary to think. Like, I was that close to it. If I hadn't found the extra, the jobs wouldn't have been enough.
Yeah, it doesn't seem these like, 100 grand used to be like, that was a nice income. Like, if you were six figures, you like, woohoo. Now it's not really enough, like, and all the jobs like that I came through university. I was working like a technical job there. Then I got into tech, and then now that all sort of finished. And I had to pivot back, and now I'm doing the handyman stuff. But all the jobs that I would have, that did increase just with like the CPI interest rate or inflation rate. Maybe my $50,000 job is now $70,000, but like I couldn't live in this city where I'm in for 70 grand a year. Like, it's tough to get by, and then people need to start thinking of if you can't get that six-figure salary just because you're not skilled or you don't have the qualifications or whatever, the experience, you need to start thinking of another way. And there is, it seems like, with the proliferation of, say, AI tooling, like things like web development, running an e-commerce business, all this sort of stuff are available, but people they're failing to get industrious. And it reminds me of that saying, good times create weak people, weak people create hard times create strong people create good times. And it feels like we're in a bit of a decay period where there's not that many hard people around that are doing that extra lifting to deal with the cards you're dealt, accept them and then still make a win out of it.
Yeah. The problem that we face nowadays is that most people want it to be the way that they were taught, right? Get a job, like go to school, get a degree, get a good job, pay that degree off, retire happily ever after. And it doesn't seem to work like that. And it doesn't work like that because what they were taught was from people who lived in an industrious nation that was producing great stuff and sending it out there to the world, and they raised their standard of living. And so they tried to apply that same principle to their kids who failed miserably at it. Now, understanding like it's going to be very difficult to get a job and then use that job to make it, because It's just like, I mean, generally you can make it. You ain't gonna be good, right? It's just like you can generally pay the bills with a regular job for the most part, but your life existence is gonna be pretty, yeah, exactly. It's gonna be like constantly be drowning. So it takes more than that, right? And that's what is really awesome about now is that there's so many ways to do things. Like I think about it personally. I have my day job, right? I do YouTube. There's a few other things that I get from YouTube, like, I have the school community and a little bit of memberships going on there. I call bingo, right? I got a side hustle doing that. Occasionally, there will be something else that pops up that I get paid for, as far as maybe in a entertainment job or something of that nature. It's not necessarily all the time, but it is something that comes up. So now I think to myself, man, being able to get extra money, even though it's not a lot of money, being able to get extra money isn't that hard. There's so many different places out there that one could go to. Even if it is just a little bit of money, it's still like, it's kind of like easy to do for the most part. Like online stuff has made it way easier. And so when we think about how it is that one could access different avenues of revenue from different locations, it's easier now to do that than any time in history. Like when I was a kid, if I wanted extra money, I had to go split firewood and mow lawns and shit. Like it was hard, to go get extra money. Now, if I want to make extra money, I got to think of the video, go out there, be somewhat entertaining, stuff like that, and I can get extra money doing that. I don't even have to leave the house, Hey, that's cool. So now understanding like that is really unique to this day and age that never quite existed before. And if you don't take advantage of it, you compete against people who do. So remember that, like, that's something that you have to internalize, that you may not want to do the extra. Oh, well, nobody wants to do anything, right? But to understand that there are people out there who are doing exactly that. They're door dashing, they're doing whatever they can on the side in order to get that extra money. And you know what they do with it? They rent the apartment. And now you can't, because you're competing against those people. So it's almost now to the point that if you have a day job, that ain't going to be enough. You have to chase the side hustles. You have to go after them. But they're so easy to do nowadays. You should take advantage of the fact that they're easy to do. And then on top of that, the extra money, all the money beyond the money you're already making. That's my favorite one. People say, you got any extra money? I'm like, what the hell is extra money? It was like, does that even make sense? Like all the money beyond the money you're already making? Like there's no such thing as extra money, right? So you go out and you get those side hustles so you can get the extra money. And then what do you do with the extra, right? Well, Cantillon said it way back. If you read that essay and you read those 3 chapters, he clearly says it right in there, that the people who are industrious, who do not increase their standard of living, right? Who essentially, do not increase their expenditures is how he puts it. Do not at first increase their expenditures, hold back, deploy that money towards a secure rate of interest beyond that of their occupation, and become the property owners. So he literally like spells it out there for you. Become industrious, don't spend it on luxuries, move it towards a secure rate of interest, and become the property owner, live independently of the state. And so as we think about what it is that most people end up doing when they get their extras, they buy the car. Like we talked earlier, they don't think, man, I'm not going to go to the apartment. I'm not going to go get a new pair of shoes. I'm not going to go do all that other stuff. And instead, I'm going to figure out which one of those dividend paying stocks I'm going to buy, or what class I'm going to take in order to level up my skills, or something of this nature, like how is it that I move into the next level? That is like unheard of as far as most people will consider it. They don't think that way, and that's an unfortunate consequence, because nowadays being able to move into like stock purchases, like Cash App or Robinhood or something like that, that didn't exist when I was a kid. When I was 20 years old, thinking about getting into the stock market, it was impossible. You had to have like stockbrokers and stuff like that working it. And then even when the E-Trade accounts came out, they were like $10 trades. So like if you were some broke ass like I was way back in the 90s and you're just learning about E-Trade accounts and stuff, and you only have $20, $30 to do it, and you got to spend $10 to get in and $10 to get out, you're not playing in that market, right? Because there's no real value other than maybe learning something about stock trading, but there's no real way of actually investing in that kind of circumstance. Well, now that ain't the case. So we have an opportunity right now to not only bring in extra money, unlike any time ever in history, but then also a way of deploying that money into acquiring assets so easy. It's never existed this easy before. So yeah, like there's two tiers: people who are doing that and people who don't.
So you said that probably the primary one there is your YouTube as a side hustle, and with that, like, what's the sort of the delay? So we've been around for through what is it, 6 months or something now. We're not monetized yet or anything like that, and so but we've had a couple of videos that done reasonably well, but you've got to hit a certain amount before you're getting monetized. And then once you are getting monetized, is it as reflective if you have a video that gets 10 million views? Do you get that money out of it, or does YouTube take a bigger, like, how what's the word there in the market? Like how efficient is the market for allocating the value back to the content creators through YouTube acting as the intermediary there? And do you think that there's a potential for say like digital assets to disrupt that and to move into a peer-to-peer content creation, and what that might look like for people to get more value out of that dynamic?
If you really want to make money doing videos on YouTube, you're gonna want to go towards sponsorships, because the ad revenue, I mean, it's good. Don't get me wrong, I'm not complaining about it, but it's really just a glorified side hustle. It doesn't really pay you that much to do it. There's times when it can do really well. Like if you got videos that are getting 100,000 views, yeah, those are pretty significant numbers that you get out of it. But even in the reality of the situation, it's like not nearly what it is that sponsorships could pay you. And so just to kind of give you an idea, like I don't take sponsorships. There was a time I did a couple of them. The sponsors that I got to actually pay me money, like the ones that I finally said, okay, you guys are just talking too much for me to deny it. They pay me $10,000 to do a 10-minute video, right? And I'm like, holy moly. Now that, right, that's the real deal right there. And now there's people out there who get even more to do a video, and they do them regularly, 3-4 a week. And so to think about how it is that you can get sponsorships to really make money, if you're looking to make money off of YouTube, that's the direction in which that you want to go, right? Now, as far as the ad revenue, there's times when it does really good, right? And lately, like over the last 6 months, or so, my ad revenue hasn't been that great. It's been somewhat diminished. Would you have a really good demographics of people? Like you think about it, if you got 35 to 45-year-old men who are interested in economics, you probably have a demographics of people that advertisers want to advertise to. Right? Because if you got a bunch of 13-year-old kids watching your gaming channel, you might have a lot of views, but you got a demographics that advertisers are like, yeah, that's not our interest. So it's kind of important to remember who it is that you're like, got for your focus group, because my demographics is very valuable, even though it might be a smaller audience than say somebody who has a much bigger audience of 13-year-old kids. And so now understanding that kind of things, when the videos are initially very popular amongst the demographics of viewers that I have, so like it's getting advertised or getting pushed out to my subscribers who happen to be within that demographics, the ads pay very well. As that YouTube video starts to catch the algorithm and it gets shared out there with a broader, wider audience, it starts to miss that demographics and the ad revenue starts to diminish. So what you could expect from a 10,000 view video to pay, like, I'm just going to make up a number, like $100. You would almost think that, okay, 100,000 view video should get paid $1,000, but it may end up paying,
because not all views are created equal based on the audience.
And even in that, like, I have no idea. Like, sometimes I'll watch a video that just got major, like, I'm like, what the hell did that one earn so much? You know, and then another one that was super popular, all kinds of, and it didn't get paid nothing.
Yeah. It's interesting. I've got a client that I'm managing his YouTube channel, and over the, let's say 2022, so that's a 4-year period, his YouTube channel maybe has earned $8,000 on ad revenue. I'm starting to do like short clips, like shorts for him, and like it's a totally different kind of system there, but like it's not earning anything notable, but it is interesting to see like how one short gets less views and the monetization value is more than another short that gets more views. So it's kind of interesting there. But I'd say, yeah, like I think the one part of his question was what is the efficiency with, like, how much does YouTube take out of every dollar that you earn? Is it like 30% or 10%? Yeah.
I don't know. All I see is the dollars I get. I don't know how much they're taking.
Oh, okay. I think it's, from what I understand, I think it's something like a 30% cut.
I know they take about 50% of my super chats.
Oh, okay. I didn't know that.
They take about 50% of the super chats, 30 to 40% of my membership.
Oh, no, okay.
And so I'd imagine they take a massive amount of the ad revenue.
On the ad revenue. Yeah, that's interesting. Those are all good ways to monetize directly with YouTube, like the super chats, communities, ad revenue. The sponsorships is external. The other way is your own products, like, or other people's products. So affiliate products or your own info products. But like the sponsorships, like you said, I think is the most, unless you do have some sort of info product business behind your YouTube channel, the sponsorship is the most potent, most like massive way. Or I guess maybe for somebody like us that we're just starting out, we actually just passed the with our last upload, we just passed the requirements for the early entry to the YouTube partner program. So we can get the super chats now if we apply. You just gotta apply.
Yeah.
You're muted. You're muted. So.
Cool. What an achievement. Moving up in the world.
So someone can send us like a $5 or $10 like thumbs up type of thing is basically what
you get those regularly in your chats when I've been in the lives. I actually sent you one. I sent you a $20 super chat and said, check out our video where we had Craig Wright on the podcast, because I wanted you to pay attention. You're like, yeah, I will. And then I was like, there's no chance. There's no chance he's going to do that.
Man, that's so mean.
No, I just appreciated the content, so I was happy to sling some money your way.
But
I guess where I was leading with that is the entire value proposition. I think with Bitcoin, when it was released with the white paper, it says small casual payments online were currently, impractical because the cost of mediation in disputes with reversible transactions means you can't facilitate a small payment that can be reversed and needs mediation, because even just 10 seconds of someone's judgment onto it to say is this right or wrong you can't pay someone that salary to arbitrate on that decision. But the core feature, the killer feature, I guess, that I believe with blockchain, and it comes down to scale, is the ability to service those micropayments that are down into fractions of a cent and transfer value in that to create more efficiency in the market. So you were saying that it's quite arbitrary and you're not sure how the advertising revenue comes in and such. Whereas if someone can just pay, you can set a paywall. I want this one, I want the 10th of a cent for this video if someone watches it, or I want them to pay 1,000th of a cent per second. And so over time, if they're watching it and you're producing good content, you're getting more and more of those thousandths of a cent because they watch till the whole end of the video, because you just keep delivering value. Whereas like if I go and rent a $7 video from Apple or YouTube and it's garbage, I can't turn it off after 10 minutes and say that's just crap and get 90% of my value back, because I committed to it and had to buy it up front. But switching to that like granularity in pricing, pay for what you consume or pay into these way smaller denominations, I think is a totally different economic paradigm at least in the digital space. And it'd be really interesting. Like, we probably don't have time now in this to chat more on that in another instance, or I would love to talk to you more about that, is fleshing out, you know, these laws of Gresham's law and Thier's law, and you know, into a new paradigm of micropayments in sub-cent values, and the business models that are available there. Because we've got you know, there's social media where you pay for a like, or you pay per image creation from an AI model, and you might pay fractions of a cent, or you pay one person buys an API plan for X, Twitter or whatever, and then they divide it into all these little individual units, and you can pay for a request that says, hey, can you give me an API request? I don't want to pay the $27.99 a month. I just want to know what the trends are on X. And you get the response back from them, and they pay, Bridget paid like, what was that, 3/300th of a cent or something like that to get these kind of requests. So there's these interesting economic markets forming around payments and the provision of digital data transactions. And
let me share something interesting. So there's this platform called Tree Chat that is like a social media platform built on Bitcoin, and I just posted our last episode on that one just to like share it around. I'm I joined probably a year ago. I probably did one post in the whole year. I have not, and then I just decided, well, why don't I start distributing our videos there, because I'm doing it on X, and now I'm going to do it on my personal socials. And it's not a big deal. Like, I got like 3 tips or whatever, but it came out to 21 cents. After 6 months of running this YouTube channel, we're not monetized, right? So like we have had like 14,000 views or so, and we had one video itself had like 6,000 views. That was the one with Craig Wright. Imagine if people could have tipped us 10 cents, 20 cents, whatever the amount of, directly, without like having to go through this monetization process, and obviously YouTube taking a big chunk of that revenue. But like, that's the interesting thing with what Todd is saying with micropayments. Like, somebody likes your content, there's no waiting period. It's a direct one-to-one, peer-to-peer, as they say, peer-to-peer interaction. So they can tip you 10 cents, $1, $10, $20, and on your first video, right? Like, there's no nothing gatekeeping, right? No middleman there. So I thought that was kind of cool. Like, it was like, oh, cool, just post that video there. It's not a lot, but I think it's cool that, you know, it's already like getting some change, and we haven't even gotten that with YouTube yet, with our 6+ months on YouTube. So I think it's interesting.
It took me a long time. I mean, I don't think I got monetized for like probably a year and a half, you know, of doing YouTube videos, and I was doing them pretty consistently too.
Yeah.
You know, like, once I did get it monetized, I mean, I should say it was like a year and a half before I got it monetized before that, because I was able to reach the criteria. But, you know, you put out a video and it makes 87 cents, you know, it's not that exciting. You know, it wasn't until the videos were like hitting, you know, $100 a piece for a while, that's when it was like, holy moly, man, I got a product here. This is something that's significant. You know, in that sense, you know, for me, I really kind of screwed the channel up when I tried to figure out how to make more money doing it.
Yeah.
It was when I wasn't giving a shit about making money that I made the best videos. You know, and that's really, I think, like, a lot of it has to do with just my own personal energy and what it is that I am, like, you know, portraying out there onto the screen. If I have like this desperate idea, like, I gotta get a lot of views on this video, the videos do very poorly. And so, like, I almost had to learn to almost like let go of the idea of making money on YouTube, so that I could be more focused on creating good content, and then allow the money to just flow whenever it was ready to. And in that sense, it did so much better for me. I try to focus on it to be like, you know, giving it intent. But again, it's like, I find it very cumbersome to try and do something that is going to like purposefully try and make a lot of money on YouTube. It doesn't seem to work out. But the more I just kind of let go and just naturally flow through the idea of making good videos, opportunities present themselves to make money. And that's really where I think, like, you know, for a lot of YouTubers out there who are trying to do this, kind of do that number. Try and just focus on making really good content and then look for the opportunities when they present themselves, as opposed to trying to make the money on YouTube.
Yeah.
And in that, in like, because like, to me, it almost seems counterintuitive to not want to make money on YouTube, but it really does, you know, kind of present itself almost automatically when you do good videos and you have a good channel. So you don't really have to worry about trying to make money on it, is if you have good content going.
Yeah, and then you're building authority rather than you are like just trying to sell it, you know, a single video as a product, and that's where, you know, in what we're trying to do is to create great conversations to bring more information and, you know, intimate knowledge out of people and what they have in a particular domain, and in that opportunity, you know, demonstrate that we have capabilities. And, you know, and Niels comes from a marketing background, in more a technical and an education background, but yeah, like that, I imagined getting invited, you know, maybe getting invited to speak on something else, and being, you know, it might not be that any of your shows, but then you go and do someone says, hey, you've done like a bunch of podcasts, do you want to come on as our guest? And then all of a sudden the video blows up because you got invited to a channel that might have twice as many subscribers, and, you know, you delivered value there, and it wasn't even your own work, that it was part of, you know, a foundation that gave you the authority, or demonstrated the value you could offer people. But yeah, it's never just a one-to-one, in my opinion. It's the externalities, or the doors that open from doing things.
But, you know, with all that being said, it's a nice way to do it, man. You know, I mean, you know, I think about it, YouTube totally changed my life. Like, everything that I had going on, if I didn't have YouTube going on, I don't know what it would be like. It would be an entirely different world. So I'm really thankful for the platform. I'm really thankful for, you know, the opportunities that it gave me. It's a little frustrating right now, but I think that's more of my own personal challenges to, you know, expand my reach out there into different projects and stuff like that. And, you know, really, it's not reflective of, like, the success of the channel. I think I've already proven that. Like, I don't really feel like I have to prove anything as far as that goes. And, you know, and I don't take like the views comparatively to like other channels who get like a lot of views comparatively to what I get. I don't consider that as my value to what it is that I'm bringing either. You know, like, if I get a video that only has 2,000 views, when, you know, I see somebody else who might have done a video that has half the information that's presented poorly get 25,000 views, I don't think about it saying, oh man, they find them more valuable than they find me. That's that, you know, there was a time when I kind of looked at that and I felt like almost butthurt about the idea. It was just like, how come they're not watching my videos or something? But then I realized I'm really refined my group. You know, like, I don't just go out there and blast a bunch of, like, I don't know, gimmicky information, headline information, crisis information just to get attention. I really want my information to be well absorbed and understood. And the people who are sticking around to my channel have really kind of like refined down to just the handful of people who are the most serious that they could be about this. Like, if you're following along on my channel to this level,
All-nighter.
You're like, you're in the deep end with me, you know, and that's only people.
I recognize the name. I'm in there in a live chat, and you're like, thanks, all-nighter, and there's a few names that you're like regularly just calling out because they're in there, and they're, you know, it appears they're your proper community. Like, they have you know who they are. Like,
stars on my channel, like that. Like, you know, you guys, if you ever met All Nighter, you would be amazed by this dude. He's a regular construction dude. He does commercial fishing. He's nothing, like, you wouldn't pick him out of a crowd, not by any means. He goes to these conferences, and I swear to God, he is more popular than some of the speakers who are at this thing. He doesn't even have a YouTube channel. Like, he has one, but he doesn't put videos or anything there. He's a moderator for like 13 YouTubers, right? I don't know how the hell he did it, but he got in and just communicated and hung out with all these famous YouTubers. And now, like, he's doing events and doing things with some of these guys like Millennial Mike and Jason Hartman and all these other dudes, like, all on his own. Like, I didn't introduce him to those guys. He went and found them on his own, you know? And so I'm at this cocktail party from the Rebel Capitalists, and I'm hanging out with all these famous people who are at the, you know, doing the speaking event. And I look over, and Old Nighter pops up, and I'm like, dude, how'd you get here? And he was like, Jason Hartman brought me, man. I asked him to take me. He totally brought me along. And I'm like, holy shit, dude, you're amazing, man. So it's not like you even really, like, you can find yourself able to make networking contacts and stuff. And you don't even really have to do anything except for be there, be in the right energy, be in the right conversations, go out there and meet the people and start talking. He doesn't make money out of any of the stuff that he did. Not from the traveling he did, not from the speaking engagements that he did, or the conferences that he went to. He never made any money at any of that stuff. But he built up such a reputation that him and Millennial Mike now are investing together over in Gary, Indiana. Now, he doesn't have any money, but he knows how to work. And so he'll drive up to Gary and he'll, like, recondition these apartments or whatever it is. And Millennial Mike will give him a percentage of the property for doing it. And so here it is. He has totally figured out how it is that he got in with the millionaires and then partnered up with the millionaires and now doing business with the millionaires. How the hell did he do that, dude? Like, you know, it was just like, and he did it just by simply being on YouTube and communicating and stuff. So knowing everybody's going to have a different style in which that they do it, the energy that you carry is going to mean everything about it. Like, what is it that your intent with this? He literally brought, man, I am like, what is it that I could possibly do? Nothing. All I can do is bring value, man. I will be a moderator on your channel, and I will make sure there's nobody spamming or using cuss word or any, like, and he went through all this, like, idea that, hey, man, I can bring value to YouTubers by being a moderator. And that sparked it off. Like, he just said, no, I know where there's value, I can present it. And then from that point on, he just kept growing his value with the people that was around him in his network. So impressive, man. I mean, I told him, I said, dude, you need to tell people how that works. And he goes, I don't know. You know, I'm like, what do you
That's
mean?
usually how it goes.
He's like, I don't know, I just talk to people, you know. And I'm like, no, man, you got the touch, man. You got the ability to network with nothing. You have not, like, he's broke as hell. He doesn't, like, you know, it's like he doesn't, but yet here it is. He's got all the big people, all the millionaires talking with him, all of them giving him opportunities or showing him ways, you know, giving him a hand. And he is just, like, taking full advantage of every opportunity that he's gotten. It's just, like, amazing to watch it go down. I'm very impressed with the guy. Yeah.
Yeah, kudos. I've only heard you talk about him, but yeah, you've always had, like, a lot of praise for him when he was up doing, because you've talked about as a way to get ahead is like house hacking or something, where you go in with a few others and you whether you're renting out, subletting a little room or remodeling and something to add value to, like, just create that, to add value to the asset really. And whether you're starting with multiple people and, you know, just splitting the yield from remodeling something with spare time you got it and putting your skills into it. You know, anyone can pick up a paintbrush, and a fresh coat of paint might add $5,000 to the price on the house. Obviously, like, there's stamp duties, blah blah, taxes and all that sort of stuff in the transaction. But if you can figure out a way that you can, you know, value add onto something and then flip it, you know, there's no reason why your money has to come through from just a wage and a, you know, paycheck that you're getting each week from just going and putting yourself in someone else's employment where they're probably making 3x on you.
Yeah. Oh, for sure. More. Yeah. You know, but here's the thing that I've kind of discovered throughout it, and I've talked about this on my channel before. It gets kind of into the crystal gripping thing, but once you kind of recognize it and you see it, you start to really start making use of it and to realize that abundance is everywhere. It's like everything is in abundance constantly, and there's always nothing but abundance. And so when people say, yeah, well, I got bills and I got, you know, all this other stuff and I got debts, and I was like, yeah, I know, you got an abundance of that, right? I mean, there's an abundance of an abundance and there's an abundance of lacking, right? And so to understand that it's always in a constant state of it, but you just got to figure out where it is that you can be in that flow of abundance. And so for like old Nider, it was easy for him. He knew he didn't have the money, but he knew he wanted to be in real estate. And so he knew that there was an abundance of people out there who invest in real estate, and he found how to get into that abundance. That was very strange. I don't know anybody else who did it like that. Like nobody. Everybody else was like, man, I got to work hard, come up with a down payment, do it like I did. Like, and he was like, yeah, I ain't got a million years to wait. I got to figure out another direction. And that's really what he came down to. It was just like, man, there is a million people out there who invest in real estate. I need to hang out with those guys. And that's really where like I started to understand, okay, how do I get in the abundance as well? Like even in my own understanding of it, what I realized and what I wanted to share and that I came to the conclusion of is that there's literally an abundance of people who have no idea what the hell I'm talking about. All right. Like that means everybody gets to learn what it is that I'm talking about. So there's literally nobody out there who I cannot address or talk to or at least share some information with, because literally nobody knows what it is I'm talking about. So there's nothing but an abundance of people out there. I need to figure out how it is that I can communicate with them. And that's really how I kind of view that abundance.
Your total addressable market's just everyone.
No, but like what was his name? The guy that you guys are referring to, or not his name, but his nickname.
His real name is Ryan.
Ryan. But like, capital money. That's one form of abundance. But like your network, you know what I mean? Like that's another form. Like there's all sorts of resources, and really entrepreneurship is all about taking limited resources and maximizing the yield out of them. So everyone has contacts. Everyone has the ability to go and reach out to somebody. Like we reached out to you. We didn't actually have any. I mean, I guess Todd somehow maybe got onto your radar with some super chat, maybe perhaps, but like everyone has the ability to reach out to people. There's nothing stopping people from utilizing other resources, other people's resources, your own resources, or just looking for the opportunity, right? Like doing the hard work, right? Reaching out to somebody cold isn't hard work, but you know what I mean? Like going out and like knocking on the doors and creating your own opportunities, right?
Yeah.
So,
one of the things, like I know for me, like opportunities presented themselves in a way that became easier for me to actually say yes to because of the conditions in which that I was handling myself otherwise. So I didn't realize how many opportunities I said no to because I would rather go drinking. Right? I was drinking a lot of, like after work, I didn't want to do anything. I just wanted to drink beer. And if I'm drinking beer, I'm not doing business. I'm not trying to figure out to chase excellence like that. That's over. And so usually like if I got off at 5 o'clock, it was about 5:15, when I would be cracking beers. So it didn't take very long for, I didn't have much opportunity to chase excellence in the 15 minutes that it would take. And I really found that it was probably one of my biggest limitations was literally not so much of not being like ambitious or wanting it or doing other things. It's just that I found that drinking was more important. And if I was drinking, I wasn't chasing excellence. And so really that once I had removed that out of my life, like I was just like, okay, so I'm not going to drink anymore. Then it didn't give me any room to say no to things, right? Like, all I could do was say yes because I didn't have any reason to say no before I was drunk or I was going to drink or something like that. So I just never took advantage of those opportunities. Now somebody says, well, here's this. And it'd be like, oh, shit. Yeah. Like, I mean, it was like normally I would have said no, but I don't have any excuses for it. So yeah, let's do it, and that really like opened up the realms of possibility to so many other things that I was literally shutting the door on. Because I was cracking beers instead.
Yeah, it's just like when you don't have that beer, you go, what do I do now? And you're like, do I smoke? Or do I? Or like, what productive thing could I do? And then you won't even having that thought before. And the first thing you do is probably not that productive, but just it's you build that thing where it's like instead of filling the void with the booze or whatever, you start filling it with like. I'm actually, maybe I was drinking because I'm dissatisfied and why am I not wealthy? Or like, why is things not easy? And you start trying to figure out, putting attention on that, instead going, okay, now I've addressed the reality here. I've been kind of kidding myself, and how do I make it better?
Yeah.
How do I grab life by the reins? And the first opportunities you pursue, they're not necessarily going to be, like I've had times where I go, okay, I just need opportunities, and 4 or 5 things come in at you like that next day when you sort of set that intention. But they were just like the little, the false starts, or the engine didn't have the choke on or something. It's like kind of kicking into gear, but you feel like, you then, none of them went to anything, so you get defeated for a few days. But if you keep that practice alive, then they just then you get to strike true, and the things, you get better discernment to pursue the right things. And a lot of the times, that for me anyway, the things that have presented, you might have a preconception or some baggage or something, and the pursuing that opportunity was the ability to learn and to shed that baggage and make the mistakes, and then go, oh, okay, I won't do that again. And that makes you be better able to get capitalize on a future opportunity. So even though it was a failure, like, you go and you end up working for $10 an hour because you underquote, and you're like, I won't do that again. And then your quoting process changes, and you get better at doing that, and you start to value yourself higher. And then maybe you miss a few on the top side, and you're like, oh, damn it. But then 6 months later, they message back and go, is that quote still valid? You were actually the cheapest. And you go, oh, I didn't even lose it. They just, they thought it was too expensive, but I was actually, at the right point. Mm-hmm. So yeah, it's never just a direct, or for me, I'd like it to be just direct instant manifestation, but it's more of a roundabout maze of learning about yourself and getting rid of the preconceptions and, things that we have that sort of devalue our self-worth and, limit what you're able to experience.
Yeah. A buddy of mine just recently shut a business down that he had. He had a little food cart that he was starting. And man, he really wanted it to work. He really wanted it bad. And he threw everything he could at keeping this thing running. He kept it going for like a year and a half or so. And it finally just overwhelmed him, and he shut it down. And I went, oh, bro, I know that was tough, right? I know that was a tough one. It took a lot out of you, the bankruptcy, all the other crap that went down with it. I said, but are you going to try it again? And he was like, hell no. And I'm like, bro, think about this, man. You know what to do now. Like, you didn't know what to do. You made all those mistakes. You learned so much from it, and you failed, but you learned so much shutting a business down that you will not be making those same mistakes again. Just consider the idea, man. Like, you have the knowledge now. You didn't have it before, but you got it now. You got all these lessons that you learned. You can start this business again, and you would not be doing the same thing that you did last time. Admit that to yourself, right? And he was like, yeah. And I was just like, so you went through the lessons of how to make a business work. Think about it, man. It was a painful experience, I know, but you went through those lessons for a reason. You didn't do it for no reason. Why? Because you really want this business, man. And if you didn't go through those punishments of all those things of shutting that business down, then you would never have the opportunity to have a badass business, because you would still be making those same mistakes. So you got to run with this, man. You got to do it. So he didn't start the business up, but he actually went and did an event. So he like went to a festival or something and, set up his equipment and everything, and did his fried fish. And he was like real excited about it. He was like, man, it's been a while since I've done it, And so he was kind of pumped up about the whole idea of it. And I could see the wheels are turning again, And I was thinking, man, that's not something that everybody has, is that understanding of what went wrong. That is so valuable. Everybody knows what's going to go right, but very few people know the lessons of what happened when it went wrong. And that really is something that I think everybody has. Like, even I myself had to go through something of that myself. Like, I don't like the idea of bookkeeping, right? It's not in me. Like, I like economics, I like studying theories, I like doing all that other stuff, but sitting around trying to figure out which numbers go, and like how much I got, like, God, what a nightmare to throw that stuff over there and pay the bill to somebody else, right? Well, that came back to kind of get me, like, I didn't file things properly and stuff. So I had to hire a bookkeeper and say, okay, help me clean this shit up, would you? And it wasn't like it was a big deal. It was just frustrating for me. And this person, they love it. They're like the analytical mind. Like they were like, no, just sit right here and I'll click all the way through it for you. And I'm like, all right. So I'm sitting on my cell phone, like with them, and they're just doing all this work for me. And pretty soon I realized I'm like asking them questions about things about the business. And they're like, yeah, do you want me to get that set up for you? And I'm like, well, yeah. And she's like, yeah, no problem. I'll have that ready for you tomorrow, whatever. And I'm like, oh shit, I needed you a long time ago, right? Like, but it took this painful experience of kind of screwing things up to finally say, okay, you don't do this right. Go find somebody who does, would you? You know, so that you can go and do what you really want to do, and then hire this person to do the things that you don't want to do because you can't do it all. And if you hire somebody who's really good at doing that thing, then you don't have to stress about it anymore. And all of a sudden, this whole world of like relief came to me, even though like it's been this burden going on for so long that didn't need to be there. But that punishment of it finally pushed me to a point that I found this person that is just absolutely perfect for my channel and helping me get things lined up in a much easier way to handle. And I thought, man, I needed that punishment because if I'm going to expand this thing into better operations, which I really want to do, I can't be screwing around with this like I had been. Like it's got to be done right. And now I got somebody doing it right. And now I don't have to stress about doing it right. I can just go and pursue the things that I want to. So understanding like that painful experience that I went through of kind of screwing things up and costing me money and doing all that other stuff was needed. I absolutely needed to go through that so that I could understand what it is that I needed to do in order to achieve the next level in my life or my business or whatever it is that I got going on. And I like to recognize that, like, you know, like to lean into those tensions. Like you don't even realize that you're trying to avoid them when that's really where you should be going. You know, like I should have been leaning towards this a long time ago. And finally, it was just like, okay, I'm going to deal with it. And I moved into the tension and then found this huge magical experience on account of it. I'm like, oh, shit, I'm going to look for more to lean into, you know, because that's where it's at. Like, it's not in the normal and the regular thing that you're doing. It's in the unknown. That's where the awesomeness is.
It's the division of labor and the specialization. Like your skills, you know, you don't want to cover all the bases. You know, you're not an accountant. You're the breaks it down, and that's where the value lies. And the more you can focus on doing that, then you know get other people who can do things 3 times more efficiently than you, and then as long as you're not on, you know, they're not making 3 times as much as you, it all comes out in the wash.
Right. She was like, an LLC for all the stuff you're doing. That's it. No more. Give me $100 here. Sign right here. You know, it's like, you got Uneducated LLC, and I'm like, Uneducated Entertainments LLC, and I'm like, oh, cool. That's nice. You know? And so it's like, you know, now I put all my stuff, like all my bingo calling and all that, it all goes into one thing, and I don't have to look at it anymore. You know, before I had it all kind of scattered all over the place. You know, so I just put it under one LLC, and now all my stuff outside of my side are all. Everything on my side hustle essentially is going into that.
Yeah. Oh, nice. Well, you know, it's been a bit of a session in here now. It's been really
fun as well. I can do this all day, man.
Yeah, we can keep going, but I'm aware it's like, what is it, 2:30 for you, Anil?
Oh, no, yeah.
It's 12:30.
Oh,
but
yeah,
this is what I would have preferred is that we ended around this time as opposed to starting at this time. So I'm happy.
Yeah, I hear you, man. Totally. Yeah, when you said that it was that late, I'm like, oh yeah, no problem, man. I did a performance earlier today, and I didn't know how long that was going to run for, but it ended at 4:00, so that was good. And, you know, it was cool. I did a scene from a play. It was so fun. God, this girl Cherry that I did this with, it was such a great little fun little interaction between the two of us in this play called Frankie and Johnny and the Claire de Lune. So I was really looking forward to it today. We pulled it off without a hitch. Everybody thought it was great, but it was just the one little scene, one little act that we did, but it was a lot of fun. Anyway, I did that earlier today, and so I didn't know how late that was going to run. That's why I asked for it to be 7. Otherwise, I could have done it earlier.
Oh, good. It worked out perfectly, I think.
Yeah, cool. And maybe, yeah, I would encourage you, like, to, you know, Anil plugged Tree Chat before, but we had a guest on the other week, John Calhoun, who's just released his platform Xanadu. So both of those, I'll share the links afterwards. But maybe, you know, if you're still creating content and you know you're using YouTube, but do you ever jump on X and plug anything anywhere else, or are you pretty much just exclusively on YouTube? And
I have an X account, yeah, and I pop off of there every once in a while, but I don't really, I'm not terribly active there. Maybe once or twice a week I'll go on there and post something.
Well, if you want to get that 21 cents,
Yeah.
jump over on Street Chat, and I've always found your content's a really refreshing way to digest the sort of economic material, and because the way that the conversation threads, it's not as painful as X, so you can kind of branch topics and move down under the architecture of the conversation. And I haven't actually jumped onto Xanadu, just got released the other day, but they're both more of this micropayment kind of social platforms where if you're creating value on there, and people are itching, they're sending money around just because they want to do the proof of concept. So if you're adding value on there, I'm sure that you'd start to get remunerated for that. And
what they're doing is they're spending good money over there in the terms that we.
That is good currency as opposed to well, really cool, man. I mean, I should definitely check it out. I mean, I would like to broaden my horizons as far as like where it is that I can post videos and stuff. I just found that I really want to be active and continuously active on those things, and I don't have anybody else kind of teaming up with me on my social medias or anything else like that. So it's just me, and when you get comments and stuff like that are rolling through constantly, it can just be a chase of just filtering through all these things. And when that kind of happened, I was like, man, this is just eating up so much of my time. I just ended up just being active on YouTube just because that's where the most activity was.
Well, just in that point, though, the replies can get monetized as well. So you make the post, you reply, someone likes your thing, and you get 3 cents for that one. Then you get like at a depth down of 5 or 6 back and forwards, you make the killer comment, and it blows up, and it's like, oh man, I hadn't thought of that point before, and that one gets you $1.50 or something like that, and people repost that depth in the conversation. So it's an interesting way
for like just literally being there and participating and content.
There's another thing though. It's like, it's one thing, like I think it's cool, whatever. It's not a big deal though, like the tips or the money part of it. But there is another aspect that I don't know if you know of a guy named Neil Oliver. Are you familiar with Neil Oliver? There's a YouTube channel. I think his YouTube channel is probably around the 500,000 mark, I believe, unless his X account is like that and his YouTube is less. I can't remember. But anyways, what would you categorize his content, Todd, as? Sort of like, because I know he's a wide-reaching kind of content.
Probably like a contrarian commentator, like that. During the COVID stuff, he didn't want to go into like full freedom, but he was picking apart the other side of the narrative. It touches on like conspiratorial, but he generally brings people on who back up the claims, and it's just a perspective that's a bit left out of the usual. That's not doom and gloomy, but it does challenge the general like consensus narrative.
So my point being is that he's wide reaching in terms of his audience. It doesn't seem like there's like a funnel of any kind that goes into some sort of like business wise. He's just doing like these YouTube channels and these talks and whatnot. But like, funny enough, he actually started following me when we first started this podcast, and like over the months we started chatting or whatever. And I haven't actually reached out to him to like invite him on the podcast, but I'm thinking about it. I told Todd about it. But one thing he told me, he's like, if I can find a platform, like one of the things that he's super, super interested in about Bitcoin is that if there's a social platform where you cannot be censored, because like that's one of the big pain points for creators and like content creators, especially if they're in an taboo-ish type of niche, the topics that they talk about. YouTube, X, you get demonetized, deplatformed, censored, shadow banned, all sorts of stuff. So that's the other big part of it. Like the monetization side of things is great. That's cool. It's direct peer-to-peer, interactions and whatnot. But like also the ability to put out really important information, right? And not being demonetized or shadow banned or censored in any way. That's the other, I think, big appeal for like content creators like yourself. And I think, I'd be happy to, jump on another call and get you onto like Tree Chat or Xanadu or whatever other platform. Like I personally haven't even signed up to Xanadu. I'll probably do that this weekend. Probably not until next week actually, because tomorrow's the World Cup. But like, you know, like I'd be happy to, you know, onboard you in that aspect, because I also, like Neil, I want to reach out to Neil. I want to get more creators that are in, we'll call it the traditional Web 2 world, kind of experiencing this new Web 3 world, right? With everything that we're talking about here with content and micro payments and whatnot.
Yeah,
So
micropayments, data ownership, and then that censorship resistance, you know,
Yeah.
and just and a more efficient market, you know, like
Sure.
monetize. You put your first video up and you get monetized, and that's pretty nice
Yeah.
way. You can you go, oh, I made 10 cents. How can I do it again? You know, or how can I make 20 cents? It's immediate feedback. Yeah.
But yeah.
So anyway, yeah. Do you have any more questions, Anil? Or?
No, I think I enjoyed it. Thoroughly enjoyed the conversation. Thank you. Thank you so much for coming on.
Yeah, thanks.
Thank you guys for having me, man. I mean, this was I love this topic. I love sharing this information. I love having conversation about it, especially getting like, you know, different perspectives, and then people like, you know, hearing maybe something about the credible threat theory, and then, you know, getting a nugget of information off of it, going, man, I didn't think about it that way. And then for me, on the other side of it, it's always fun to hear other people's perspective of what it is that I've had to share and how it is that they relate to that information. And so for me, this is my passion. I love doing this. So thank you guys for bringing me on. Yeah,
great. So anything you want to plug? You've got Uneducated Economist on YouTube. You've got an academy or something like that. I never took you up offer, but
that's kind of like the big thing that I've been working on lately. Is the UE University. It's through the school.com. It's really a great platform that has given me the ability to really kind of take that refined group even into a tighter select group of people who have like really truly internalized the credible threat theory. We do Tuesday and Saturday webinars in which that even the members of the school community are now coming on, and instead of like me presenting things, they're starting to present things that they have found using the credible threat theory, some of the speeches that, you know, they're filtering through, and then sharing how it is that credible threat theory is now playing out within the economy when it comes to like doing stock trades and different things that I'm just not truly aware of. Because I'm just not into that sort of, you know, view or mindset. So as other people who have like basically taken the information that I have shared, internalized it, and then now sharing it from their own perspective, from their own, you know, trading, business, information that they have gathered, it's really become such a tight community of people who understand this particular way of looking at the economy that really, I just don't know if it could even exist anywhere else. I try to share as much as I can on my YouTube channel, but until it's like actually taken in for your own point of view, and then many of those people having a conversation, sharing on that, I don't know where it is that it can get more refined than that. And right now I'm so excited about that school community because it really seems like we are hitting on, like, I honestly feel like we are nipping on the FOMC heels. Like they can't really hide anything from us.
The FOMC?
The FOMC, the Federal Open Market Committee, the ones who vote on monetary policy.
Oh yeah, you reckon you're interpreting their signals with like a higher degree of fidelity, and what that nipping on their heels?
Yeah, well, like they can't really hide anything from us anymore. Even like soon as they said that they had the task force and they announced who they were, my crew is filtering through all their past documents and stuff, and they're pulling out documents and they're saying, hey, check out this section right here where they talk about how it is that they can use expectations in order to, create some inflationary pressures. And now this is coming from the new, member on the committee of communication, when it comes to the Federal Reserve. And when you find like they're communicating this stuff back in the great financial crisis, and then you find that almost that exact same excerpt, is that how you say it, the little section out of the speech, when you find that from 2005 almost word for word delivered again in 2024 within a speech, you know that there's a connection between these two. And if you could just start filling in the blanks between that. And so this is really where I think my my crew, like I call them the fuzzy dice crew, just because, you know,
I know you're fucking, yeah.
right, you know, but the fuzzy dice crew has really, like, I don't even know how to put it. Like, we are breaking this stuff down in such a way and internalizing it in such a way that it's like becoming so clear what it is that they are doing that it almost seems we're the only ones who know it, because I cannot find anybody else who talks about it. And what's crazy about it is, like, if you take like all, like, you know, take 100 documents and you're like, okay, look here, 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 right? And then it starts telling this long story, but it's not in one single spot. Nowhere is it. And this is where I find, like, you know, that UE community is starting to concentrate that information into like one that you don't have to filter through 1,000 things. You can just go through these handful and get the clear picture from it. And it's like, it's amazing. I just love it. I absolutely love it. I look forward to every webinar to hear what it is that the other people have found, what it is that they're sharing, their understanding of it. And it's just like, to me, it's like one of the most enlightening couple of hours that I can get within all the stuff that I do, is to hear how it is that other people are finding this and using that information. It's just like, it's so amazing to me.
Do you think it's relevant for, like, you know, me in Australia as well, or is it more for you know, an American market?
No, it's absolutely, totally. It's pretty much for any. I would say that it's for pretty much any advanced economy.
Yeah.
You know, and even on the lessers that aren't necessarily like of the advanced economies, I think even on the lessers, it would still be quite, you know, useful and prevalent within those structures as well. But it really comes down to that all essentially have the exact same problem. And it's the one that I try to share, and it's very difficult and it's very esoteric, but it's the low neutral interest rate environment. And once you kind of wrap your head around all the nations simultaneously were suffering through the same situation of having a very low neutral interest rate, one that was very close to zero, all of them needed to go through a reflationary period. All of them got it. Right. All of them have pushed up their interest rates. All of them have removed their lower bound constraints as far as their monetary policy goes. They're not dealing with the lower bound anymore. And this is now becoming the more featured focus part of almost all these advanced economies, is to maintain those elevated inflations. They say they don't want them, but they really do. Right. And when you see how and why they really do, it starts to make a lot more sense that all of them are going to basically go down the same road. Yeah.
The higher the inflation, the more buffer you have with the interest rate that is declared.
Like, here, let me see. I can kind of, like, you know, basically, if you can imagine, like, if you have the lower bound of zero, right, and then over the years you had this neutral rate that kind of eventually got down to zero, something like that, kind of moved up. Actually, it kind of fucked up and then down. But anyway, it got very close to zero. Then you have a Fed funds rate that's elevated, but then you have the crisis in which that they take the interest rates to zero. They can't get far enough below this neutral bound right here before hitting the lower bound of zero. So this little gap right here is not enough of a stimulating effect within the economy for them to actually stimulate. If they could go into negative territory, then they got room to stimulate. But because the neutral level is so close to the lower bound, this little bit does not give them the room to stimulate. So now, if we think about it differently, in a sense that if you have an inflationary pressure that's existing within the economy, even though you may have the lower bound of zero and a low neutral interest rate that exists, the Fed funds rate on top of an inflationary scenario would then put the Fed funds rate at an elevated area far above that neutral position, so long as the inflationary scenario is taking place. The moment that the inflation disappears, the Fed funds rate returns back to the lower bound of zero where they are neutral, and then if they run into a downturn, they won't be able to get below that zero lower bound. It's kind of difficult to just draw it out like that and show, but really when you think about how it is that if the inflationary pressure is constantly pushed into the economy, that lower bound of R, or R star being close to the lower bound, is no longer a constraint, because the Fed has to be above the R star in order to combat the inflationary scenario. Once the inflation is gone, so is the stimulating effect that lowering interest rates would have had, because now you're going to hit that R star and not be able to get below neutral interest rate. So keeping inflation elevated within the economy is the key feature to stay above that R star. And if you can stay above R star, now you have a communication about interest rate adjustments. And that's really how they can operate. Because once you get to R star, you can't communicate about interest rate adjustments anymore. There's no stimulating effect. You're like, I'm going to lower interest rates and it ain't going to do anything. So nobody's going to be worried about that. But if you have inflation that is running persistent within the economy, keeping you well above that R star level, now you have a Federal Reserve who can maintain those elevated nominal interest rates and then communicate about it. The moment that the inflation goes, they go back to R star and they can't get below the lower bound of zero to stimulate the economy because of how close that R star is to the lower bound. I don't know. Does any of that make sense?
It does. And it was essentially just to play the game, you just got to accept, instead of bitching about inflation, you just accept it is and just move into assets and just, trying to get a yield that increases beyond that inflation and get access to, if you can get the cheap money with that lower interest rate and putting that into something that's going to get you a yield, then that's the escape hatch from the situation.
Well, yeah, I mean, you obviously you got to try and beat the inflationary scenario, but really, I guess again, you have to kind of look at it as two different positions. Are you looking at it as the wage earner who is hoping that the inflation is going to come down and benefit your wages and get you going a little bit further that way, or are you going to look at it as the asset holder? And again, this is kind of like how we started the conversation off, is that there's almost two different views of looking at it. For most people, they're going to look at the inflation coming down and think of that as a good thing. Right, and think, man, this is going to be awesome. But the reality of the situation is that if that inflation comes down and the Fed stays elevated, like if you have, inflation that's running high and then all of a sudden it falls and the Federal Reserve stays up here, inflation comes down here, that's a huge amount of restriction that's in the economy. So the moment that the inflation starts to fall, the restriction starts to kick in within the economy. And that's not where a lot of people are anticipating, being in like good times. Like they don't think that as good times, or they don't realize what they are facing is not the good times. They think it's good times because the inflation has come down, but they don't think about the interest rates rising or the real interest rates rising. Mm-hmm. And now when it comes to the real interest rates rising, if you have a situation in which the Federal Reserve has stayed elevated and the inflation has come down, like, how is it that people can borrow in that economy? Okay? They're like inside of that economy feels very difficult. Interest rates are elevated, but inflation is down. So like if you had interest rates that were down and inflation that was elevated, that's easy borrowing, right? But it's very difficult to try and pay back that loan with devaluing dollars. That's very cumbersome and difficult and slows the economy down. So to understand like how it is that the inflation falling raises the real interest rates and actually burdens the economy is something that really only the asset holder is going to look at in that fashion. Otherwise, everybody's going to look at it as a wage earner and say, when the inflation comes down, my paycheck goes further. So that's a good thing, but it's not a good thing because it's actually restricting the economy.
Mm. Yeah, you got to think of the whole organism, not just yourself, eh?
Well, not just yourself. You have to think about yourself and what it is that you're really positioning yourself as. Like, I mean, if we want to position ourselves as a wage earner, we can look at the economy and basically look at the information that is being propagated out there on the mainstream media and kind of run with that, because that's really kind of like the legitimate view for the wage earner. Inflation comes down, that's a benefit. But if you want to take it from a different direction and look at it from the asset holder and say, well, no, if inflation goes down, that's going to be a burden on paying back debt. That's difficult, right? That's not good. That's bad. Well, the wage earner says, no, it's good. Deflation is good. The asset says, no, it's bad, right? And so now you got this, like, which one is good and which one is bad? It's the discussion that go ahead, man.
Well, because you can be an asset holder that doesn't hold debt too, right?
Oh, absolutely.
So in that scenario, inflation coming down is a good thing still for those asset holders.
Well,
You
inflation
don't have debt if you don't have debt to pay back.
Well, I mean, you think about it, if you're an asset holder that didn't purchase the asset using debt, then most likely you're hoping for an inflationary scenario to kick in so that your asset goes up in value.
Yeah.
So
In the-
either way, if you're an asset holder, you want inflation. And now wanting it is not necessarily the same as like being in a good position as an asset holder, right? Like wanting it means like, oh, this is good, right? But that may not necessarily be good. But if
you're
I'm
more than
being holder,
up, but you've got this luxurious demand and you're like trying to live it up, thinking, yeah, my house has gone up, I'm going to get the Ferrari. Doesn't mean you're in a good position just because if you maintain the same level of standard of living, then it's probably a good thing for you. But going for the luxurious experience undermines that.
absolutely.
Yeah.
Oh, well, definitely. See, like, here's the thing. Like, there was a time in this country, being the wage earner was definitely the position you would want to be in. Way more than the asset holder. It was way easier to be a wage earner than it was to try and invest into assets and then hope those assets go up in value and pay you and all this other stuff. That was a real nightmare of a position to try and take. People were okay. They were okay at it. Like, they could do it. And there were some people out there who did it really well. But for the most part, if you were a wage earner, that's all you need. Like, that was the easiest position to get into. You could go get a wage. It was more than enough to pay for your entire life, and you could get all the extra you wanted from it. So being a wage earner was definitely the spot that you would want to be in. And it didn't really matter like what else happened out there. You like being the wage earner was going to do it. But now, like, that's not the case, and so we've like evolved away from the ability for the average everyday person to use that wage earning position to actually position themselves well. There was a time that could have done it. It was okay to do it. In fact, it was probably easier to be a wage earner than it was to try and figure out how to invest into assets that paid you over time and did it right. So knowing now that it's evolved away from that, like the wage earner in this economy doesn't have that good position anymore to then take advantage of. It's just like that was something back in the day when we were a productive saving nation. I mean, think about it, like just the simple idea of owning a car, right? Owning a car now is a super luxurious experience, right? It's like it costs an insane amount of money. Now, back in the day, even when I was a kid, you could go down to the wrecker and, go get a car and twist the wrenches on it and get it back on the road and make it run. That was a real thing that actually took place. And prior to my generations, that was almost like a thing that was almost expected to happen. Like, people said, hey, man, you want a car, you got to go fix one up, right? And so the understanding of having a car as a wage earner was pretty easy back in the day because as wage earners, we could go down to the wrecker and get a car and then get it on the road and actually have transportation. But now the wage earner has to go out there and buy a car. That's very difficult. And if all the wage earners have to all go out there to buy a car and none of the wage earners are going and getting a car from the wrecker and putting those cars on the road, there's a whole lot less cars for the wage earners out there. And this is really what's, and again, it's driving the divide. We as Americans used to be able to produce things for each other. Now we buy that stuff from other nations. And this is really where the downfall of America is going to kick in. It's the retirement funds, because Greenspan said it best. He said that, you can guarantee a payment from the government to any size, to any degree, to any length into the future with zero chance of default, right? Like the government will pay every single bill that it has ever had, guaranteed, as far out as you want to go. The only problem that we are going to face is that you cannot guarantee the purchasing power of those payments. So although you may be able to get those payments out there to the people, their ability to use that to benefit their life is going to diminish as time goes on. And that's the unfortunate circumstance we now face, is that really most of the people out there are going to face that exact same consequence, is that they are not going to be able to be compensated enough, whether it's from their wages or from Social Security or from anything else out there, in order to have that elevated standard of living, or one that we even feel is appropriate, like being able to buy a car. Like those things are going to get harder and harder.
Oh man, I think I need to join the school. You know,
Hey, Todd, you're gonna love it. I mean, even like, I mean, there is a little bit of a membership fee that goes along with it, but you're gonna get all those speeches that I have compiled. I have them highlighted. You can take those PDFs and keep them for yourself, share them with your friends, do whatever you want with them. Like they're like, that's the gift for joining the community, is you can go and take all those speeches and use them for whatever you want.
you were telling me to get them for free when you first fired it up, and I'm like, oh yeah, I've got to sign up. You've got to sign up and just mug all those PDFs, and then just failed to execute, and then now I've got to pay the fee, but that's all right. Being around people that are talking this language, because it's like if you're just shit talking with your friends, you don't build a culture of striving for excellence, or striving for the material success. Not that material success is everything, but it's nice to have that, to be out of survival mode and to be in a position where you start to play the game and you can enjoy it. And the love of money, like putting money above everything else, is not the best way, but there's nothing wrong with making money and having the capacity to have options and freedom and to choose and to deploy it into, you can be philanthropist and put it into things that you want to see, flourish in the world. So it just gives you that freedom by having it, and being around people that are talking that language and presenting opportunities and asymmetries in the market where you can then position yourself to take advantage of that is going to give you a massive head start than if you're just hanging around friends, cracking stupid jokes and talking about TV shows.
Oh, absolutely. And it's fun because we have great conversations. Like, like everybody's talking about their day or doing whatever, just kind of casual conversations. But, I had a guy come in the other day and he was just like, man, I really want to talk about dividend paying stocks. Can we, ask some questions about that or talk about that for a little bit? And I'm like, yeah, man, like, what's your questions? And like, really, I think he was just embarrassed that he didn't quite understand what dividend stocks were and what that meant, what it meant to have a dividend paying stock. And so he was asking kind of some simple questions. And I was just like, I'm like, here, bro, let me give you an example. I bought Altria, ticker symbol MO. Once a quarter, I would get a payment from them and it would show up in my account, like as if somebody just simply handed me cash. And so I had the stock, but the payment came through like as a cash payment into, my Cash App account. And I can take that and deploy that back into the stock if I wanted to. And then he was like, oh, okay. All right. And then all of a sudden something clicked for him inside of that. Like it was something so simple. Like he probably could have Googled it to figure it out. But he was just so stuck on this idea. And then after it clicked for him, all of a sudden, like the audience started lighting up with what it is that they had done with their dividend stocks, what they had experienced when the stock price rose and the dividend fell, how it is that they were charged tax on it. Like all of a sudden, all these questions started coming up, and then answers for them that weren't even really like introduced. It was just like kind of just organically happened. After that, the guy, it's like, he emailed me. He's like, dude, thank you so much. That answered so much for me. And I'm like, yeah, no problem. So we just like literally took his little issue. It wasn't little for him, it was big. For me, it was just something very simple, but we just cleared it up. Like the community, like just basically, here, dude, let's get you right on the right page so that you can view it better. And it was amazing to watch it happen. Like
he'll probably go, over a couple of years, he'll just outperform everyone because he's just got the bug now.
What's that?
Hopefully he just goes and outperforms everyone because he's got the bug now, and he's like, oh, let me add it,
Yeah, like all of a sudden he was just like
empowered.
Finally got that click or whatever he needed to start pursuing the information that would get him into doing what it is that he needed to do. it's so fun to watch, you know. It's like in what I really like, I just love how the community is kind of like almost doing its own thing. Like at this point, I'm like, holy moly, man! Like that's neat. Is like I'm just gonna keep pushing it and hopefully get more people in there and then let's see where it goes. You know?
Yeah, fantastic. So anyone listening, get on over there if you want to understand money, understand, you know, what a dividend paying stock is, understand economic forces. Also, while you're doing that, like and subscribe to the Proof of Claim podcast so we can get more content like this. And hey, it's been real great to chat. Great to have a two-way exchange of all the information between you, because I've just been listening, soaking up your stuff for all these years. So thanks for coming on, and hopefully take Anil up on his offer, and you know, can handhold you and onboard you onto some of the platforms that and yeah, maybe you can find a rich community in some of our network to you know, get some conversations going on, add value, receive value, and just bring each other up.
Yeah, no, I appreciate it. And that's really what it's all about. Like, I mean, you know, to share the information is really to share it in such a way that we can benefit from each other's ideas and understandings. And that's really what it comes down to. It's like, you know, you're never going to get anywhere by trying to push other people down and then confusing them and making them, like, you know, essentially not do well for themselves. The more other people do well for themselves, the more that, you know, you're going to be able to, you know, rely on them for your network, for your, you know, skills and business practices and everything else, if we're all like kind of helping each other out and making it, you know, making it easier on each other.
Grow the pie.
And that's really what I love about, you know, even sharing the idea of what's going on within the economy. Is just literally, it just gives people a much better understanding on how to position themselves. And the better we do that, I think really honestly, the world can become a better place. You know, if we could like grasp our own economies, own it for ourselves, and then make an appropriate decision like that. But, you know, we can only hope.
Well, thanks for doing your part. Yeah, so thanks again, Anil. Anything from your end, or should we wrap this up? And
I can wrap it up with one closing question for you. And so, given that our podcast name is Proof of Claim Podcast, what would be one claim that you'd want to leave our audience with? You could keep it short and succinct, 1 or 2, 3 sentences long, but to summarize kind of everything that we talked about, what would be the one claim that you would want to leave our audience with thinking about today?
You know, my personal kind of claim to, I mean, what I would like to be fame with my channel is, you know, to like internalize the message that is being delivered out there so that you can recognize how it is that the markets are behaving to that. Because it's really it's like one of the biggest mind games. Not even a mind game. It's more of like the biggest gaslighting in history.
Mm-hmm.
You know, and like just like any other, you know, manipulator out there in the world, once you recognize it, you pretty much neutralize their power. And that's really what I feel like this channel can do. And it's not necessarily going to neutralize their power in the broad sense, but it can definitely neutralize it against you and how it is that you position yourself, because you're not going to fall for a lot of what it is that's being pushed out there and a lot of the misunderstood and propagandized information. You're going to look at that stuff, like you're not going to ignore it. You actually use that. You know, that's actually becomes the thing that you're looking for so that you can recognize how it is that they are delivering the message out there to the people. And it starts giving you a much different understanding of things. So my claim to it, I guess, is to, you know, for me is like the credible threat theory and the understanding of like expectations and how those expectations are delivered out there. I think, like, you know, the more you focus in on that, the more you talk about it, the more you recognize how markets behave to that, the more you're going to start seeing a clearer picture of it. And again, the only way to really get a good understanding of it is to have conversation with people who are talking about that.
Yeah. Awesome.
cool. Yeah, well, study up on the credible threat theory.
It's good. It's good.
sharing it all the time, and at first you're like, what is this? But then after you hear it for the 5th or 6th time, you start going like, oh yeah, I get what, I at least can sort of paraphrase it now.
Yeah, and it has a really cool title to it too. It sounds ominous. Incredible threat.
Yeah.
Cool.
Incredible. Okay, well, thanks a lot. We'll wrap this up. I guess, Anil, you can.
We'll just
talk about that. Yeah.